request everyone to join me from the foray to the banquet. Good morning. Sir, I know this is Friday weekend, which started yesterday. There was relaxation, there was catch up with friends and family, and we were all awake till late night. But still, in morning 9 a.m., we all are here for the event on tax accounting, sustainability, and M&A, merger and acquisitions. Please give a round of applause to yourself because it's the hunger for learning and networking which makes us to get up early in the morning and reach here and attend this conference. Thank you all. Give a round of applause to yourself. Sir, taaliya to bajegi nahi? Thank you. Thanks a lot. We truly admire your zeal for learning and networking. Welcome to all our dignitaries, elite speakers of the day, my heroes, my past chairman, our regional director Pradeep Singh Baweja, all my seniors and fellow members. Welcome to one more event of ICI Dubai, and this is on tax account and sustainability. Before we move further, we need to pay respect. Respect to the departed soul of UAE. UAE lost one of the loyal son, in words of our president of UAE. We will observe 2-minute silence for His Excellency Sheikh Sayyid bin Zayed bin Sultan Al Nahyan, who was a prominent member of the ruling family of the UAE. His contribution to philanthropy and public services left a lasting impact on the nation and beyond. Simply pause and remain silent for 2 minutes as a mark of respect to him. Thank you. First thing first, let us make note of all the changes in the agenda. The agenda and flow of the event remains same. The only change in agenda is that we are blessed to have an additional panelist, Shahrukh. No, not Shahrukh Khan, but equally talented and versatile Mr. Shahrukh Dhumaisia, who as a panelist will be addressing questions on mergers and acquisitions, restructuring, due diligence. Thank you, Mr. Shahrukh, for accepting our invite at such a short notice and gracing the event. Thank you. Now, without further ado, let me directly invite our chairman, Sri Hari Kishan Rankawat, on the stage for his chairman's address. A round of applause for the chairman of the chapter, CA Hari Kishan Rankawat.
Speakers and panelists of the day, Mr. Basil Arafi, Mr. Kabir Dhawan, Mr. Shahrukh Dhumaisia, and CA Rishi Agarwal. Moderator of the day, CA Abbas Ali Mirza. Guest sponsors, Galaxy of the former chairman, my colleagues in the managing committee, and respected members of the chapter. A very good morning to all of you. First of all, I would like to place our special thanks to our expert speakers, panelists, and moderator for taking out of the time out of their busy schedule to address our members. And I also welcome each one of you for our summit, Accounting, Taxation and Sustainability. I would like to especially thank our former chairman of the ICI Dubai chapter, former managing partner of Deloitte, chairman of the 21st session of ISAR at the UNCTAD, and author of 15 IFRS books, a versatile singer, for accepting the role of a moderator today. And he has actually traveled from Mumbai just to attend this conference. So can we have a round of applause for Abbas Ali Mirza? I would also like to thank Mr. Shahrukh Dhumaisia, partner of KPMG, for accepting our invitation at such a short notice to address us on debt restructuring and M&A during the panel session. So please, I request all of you to stay till the last minute to listen these experts. Friends, our first speaker, Mr. Basil, will be sharing his insight into the IS 12 on taxes and their accounting treatment in financial statement. IS 12 requires entities to account for current and deferred tax based on applicable tax rates and tax laws. So IS 12 presents several challenges for the corporates as well as for accountants like us. For example, determining deferred tax assets and liabilities requires various assumptions about the timing of the future transactions, which are generally uncertain and subject to change. Then another example, identifying and measuring temporary differences between accounting profit and taxable profit, which can be subjective and which will lead to a lot of variations in reporting. One of the challenge might be like assessing the uncertain tax positions and determining the likelihood of their acceptance by federal tax authorities might affect the recognition and measurement of tax assets and liabilities. So I leave it to our first speaker, Mr. Basil from Deloitte, who will be sharing his expert view on IS 12. 2 days ago, the UN Secretary General quoted, "The era of global warming has ended." People thought it's a great news, which was not. Then he repeated again, "The era of global warming has ended because the era of global boiling has started." So friends, this is the time to gather and discuss one of the most critical challenges of our time, that is sustainability. I would like to remind each one of you once again that the theme of the current year of the ICI Dubai chapter is Sustain through Innovation, and theme of the UAE is also sustainability for the year 2023. On 1st July last year, our Prime Minister, Mr. Modi, banned single-use plastic in India. This year is our turn as a responsible global citizen to stop these uses of single-use plastic in our personal life. Every choice we make today will shape the world tomorrow for future generations. It is not enough to acknowledge the importance of this matter. We must actively embrace environmental responsibilities in our daily lives. When our company is preparing the annual budget, because now we are approaching September, October, so we as a chartered accountant actually should encourage them to budget and support the initiative of sustainability. Our second speaker of the day, Mr. Dhawan from GT, will be sharing with us how to prepare strategies for sustainability. Friends, let me update you with our forthcoming events. ICI India has gone globally now, so they are going to organize a conference on insolvency in Singapore on 4th and 5th of August, and the topic is Resolve 2023. The objective of this conference is to teach us how to resolve the dispute instead of dissolving the company. We will be starting our second 5-day masterclass on corporate tax starting from 5th August to 27th August and on every weekend. First corporate tax class, master class is already finished the mid of the month, and now we are starting second class. There are a lot of efforts going on by the executive committee. So can we have a big round of applause for our Secretary CA Jayaprakash Agarwal, Treasurer CA Rishi Chawla, and our ExCom member CA Asna, CA Malvika, and CA Sanjay Gagrani for arranging successfully these master classes on corporate tax for the benefit of our members. And we will continue to do that. We will be celebrating Indian Independence Day on 12th August evening with cultural performances. Our Secretary, CA Jayaprakash Agarwal, and Treasurer, CA Rishi Chawla, have planned a sports event on 19th of August, the details of which will be shared soon. Kindly note that one event on the corporate tax clarification will be organized sometime at the end of August, in the last week of August. And on 13th October evening, there will be a Kavi Sammelan, poetry, at Rashid Auditorium at Indian High School, for which we thank our sponsor, Delhi Private School, and their Vice Chairman, CA Dinesh Kothari, for his unwavering support all the times to bring this event under the ICI Dubai chapter umbrella. Now, UN is organizing World Investment Forum in Abu Dhabi in association with ICI India, ICI Dubai chapter, and ICI Abu Dhabi chapter for 5 days from 16th October to 20th of October during the current year. Registration is free. So please avail this opportunity and register at the earliest possible. ICI India is organizing one more global conference, ICI Research Awards, in association with ICI Dubai chapter on 19th of October during the current year. ICI India is organizing one more global conference, GLOPAC, from 24th November to 26th of November in Gandhinagar, Gujarat. 7,000 participants will be attending this GLOPAC conference. And this will be just like WACOA, World Congress of Accountants conference, which has happened in Mumbai last year. So I humbly request each one of you to register for these events and take the opportunity to gain some insight or knowledge on various topics. And I will also be attending these conferences. As you are aware that our first study tour has gone in the month of April to Kerala, God's own country. Our second study tour has gone to Pattaya in June. Both the tours were well received and enjoyed by the members along with their family members. Friends, now our third and the last study tour of my term is going to be in, anybody can guess? Japan. Yes, there are few members who are aware. So please be ready for the Japan, and we will be going from 26th of November to 3rd of December during the current year, because there are a lot of holidays during that period. So please avail this opportunity. And tomorrow's circular will be issued by the Secretary, C.A. Jayaprakash Agrawal. And all these tours actually were successfully conceptualized and executed by our member, C. Amit Khetan, with the help of our travel partner, Uranus Travel. Thank you. At the end, I would like to wish you a great learning and also wish you all the best for the 75th glorious year of the ICI. Thank you. Namaste and Jai Hind.
Thank you to the Chairman C. Harikishan Rankawat for sharing the calendar ahead with us. I love the part he ensured that I am sending the circular tomorrow by mentioning that Secretary will be sending the circular tomorrow. Thank you very much for that. Moving forward, let us get into our first technical session of the day of the topic, IAS 12 tax accounting. The word current tax and deferred tax are not new to all of us. Somewhere, while preparing for CA examinations, we have faced these words, eye to eye, face to face. It's just when we landed here, most of us are not in touch with these words. But with corporate tax in UAE, it's time to refresh our memories. And this session will help us to pull back those learnings which is stored somewhere in our RAM, in our brain. So it's time to know what is current tax, what is deferred tax, methods to follow to compute these taxes, and how to disclose what are the disclosure requirements as per IAS 12. Because at the end, IFRS is adopted accounting standards in UAE, and IAS 12 is a family member of IFRS. Mr. Bessel will take us through IAS 12, but before I invite him on the stage, let me invite our Vice Chairman, CA Rajesh Kumar Somani ji, for introducing Mr. Basel to all of us. Sir, please come. A round of applause for CA Rajesh Kumar Somani, the Vice Chairman of ICI Dubai Chapter.
Our ever-active Chairman, Harikishan ji Rakawat, honorable speakers and panelists, and respected seniors and fellow members, welcome and very good morning to all of you. Mr. Basel has an experience of more than 15 years in serving multinational corporations with corporate tax related matters, including income tax accounting. Born in Syria, raised in Montreal, Canada, Mr. Basel is a Bachelor of Commerce degree from the John Molson School of Business, Concordia University, Montreal, Canada. And after doing that, he is also a member of Canadian Institute of Chartered Professional Accountant and American Institute of Certified Accountant. He is recently shifted in the last December to the Dubai and leading a team that is rapid expansion and has actively participated in several conferences, webinars, seminars, and other events around the introduction of UAE corporate taxes. In addition to leading the business tax practices, Basil is also the lead partner for all income tax accounting matters. He has also dealt with the FATCA-related matters, income tax withholding, credits and incentives, US tax reform, and taxation of pass-through entities. I welcome Mr. Basil and give the big rounds of applause to Mr. Basil and have a great session.
Good morning, everyone, and thank you again and welcome. Thank you for having me this morning. Very happy to be here. As presented, I used to live in Canada. I've been in Canada with Deloitte for the last 15 and a half years and moved to the UAE back in December. When you look at the UAE, for the last 2 years, there's been a tremendous transformation from a tax perspective. The landscape is constantly evolving. It is really an exciting time to be here. Maybe just a tax geek would say that, but this is the place to be from a once-in-a-lifetime career opportunity for the introduction of UAE corporate tax. Comes with that is a very dear topic to me, but not dear to many accountants, the world of income tax accounting. As we navigate through the changes from a UAE corporate tax perspective and its implementation for the first time ever, we need to think about income tax accounting. It is one of those topics that will require attention immediately and even more so towards year end. On today's agenda, I've decided to take something a little bit more easy, focusing on such a complicated topic. We're going to go through IAS 12, but we're going to go through IAS 12 in simple steps, going back to the basics, understanding what is the objective of IAS 12, what are the basic concepts behind it? When we talk about deferred taxes, how do you measure deferred tax? What are the rules around recognition of deferred taxes? Financial statement presentation, financial statement disclosure, the very hot topic of uncertain tax positions. What does that mean? How do you account for it? When do I have to think about that? And we'll finish off with some critical areas of concerns that we can address as part of the panel also later on. So without further ado, the objective of IAS 12. The objective of IAS 12 is simply to prescribe the accounting treatment with respect to income taxes. These are the set of rules around accounting for current taxes, deferred taxes, how do you present it, what are the transactions that are implicated, and how does that all appear on the financial statements at the end of the day. The main issue is how do you account for the current and future tax consequences of two things. Of the settlement or the recovery of carrying amounts of assets and liabilities that are currently sitting on your balance sheet or your statement of financial position. And how do you account for current and future consequences of transactions and events that are happening in the current period. There we go. Where the areas of complexity will come in is arising from the fact that taxable income is not the same thing as accounting income. And the differences between the two is what give rise to what we call permanent differences and temporary differences. And we'll get into those definitions a little bit later on. Permanent differences are really differences that are in treatment between from a tax perspective versus from an accounting perspective, that will not revert in time. Whereas temporary differences, those are purely timing differences. So if you think of depreciation as an example, if one person decides to depreciate an asset using straight line method versus a declining balance method, while both assets will eventually get depreciated down to zero, during the life of the asset, the depreciation will be different. Similar concept from a book to tax perspective. The book depreciation can be different from the tax depreciation, but that's just a temporary item because at the end of the day, we're going to come back to the same end result. So IS 12 really is designed to recognize the current and future consequences of transactions that are recognized in your financial statements, whether it's on your balance sheet or on your income statement. Basic concepts. We've all seen these already. Current tax expense, deferred tax expense, income tax asset, income tax receivable, and deferred tax asset and deferred tax liability. What is a current tax expense? Simply put, it is the amount of taxes that a company will owe for the current period. Simple as that. So this goes on your statement of profit and loss, on your P&L, statement of financial results. It is related to the current year activity. It is related to your current year results. And essentially, if my current year results show me $1,000 of profit, how much tax do I have to pay with respect to that? Now, current tax could also include other things that are related to previous periods. If I receive an assessment, if last year's provision, my estimator of taxes was not accurate, and upon filing a return that has been changed, what we call a true-up or a return to provision, those would also be appearing from a current tax perspective. Deferred taxes is the amount of tax that you allocate during the period, but is related to taxes that will be coming in a different period. So deferred taxes are related to current year results, but might be coming from transactions that occurred in the past or that will occur in the future in terms of becoming a current tax. Income tax receivable is what we have on the balance sheet. It is essentially a combined amount of the income taxes that is payable or refundable from the tax authorities for current and previous periods. And deferred tax assets and liabilities is the amount of income tax that are payable or recoverable in future periods. Be straightforward. We talked about permanent differences and we talked about temporary differences. So again, permanent differences is the difference between the financial accounting treatment of an item versus the tax treatment. And one easy example will be meals and entertainment. When you look at the UAE corporate tax law, meals and entertainment are only deductible for up to 50%, meaning half of it will not be deductible, whereas obviously on your statement of P&L, statement of financial results, you have the entire amount treated as an expense. That will give rise to a permanent difference. Temporary difference, we talked about it. It is the difference between the carrying amount of an asset or liability in the financial statement compared to its tax basis. When we're thinking about tax accounting, we always have to keep in mind that we're using a balance sheet approach, meaning you don't start by looking at your income statement to see what was my profits for the year and therefore what is my tax rate. That's actually part of the last steps. But your first step is to look at your balance sheet. You look at your statement of financial position, you identify your assets and your liabilities, and you say, well, what is the carrying amount versus what is their tax base? That is what's going to give you your final balance sheet picture, and then you work backwards. What was my opening balance sheet amount? What is my ending balance sheet amount? The difference needs to go through your P&L. This is a really interesting slide. I like this slide because it depicts the difference between the mindset of a tax preparer versus a tax accountant. When you're preparing a tax return, you think about, well, what is my starting point? Book income. Book income under IFRS. Perfect. How do I get to taxable income? Well, I have to make a few adjustments. I need to add back certain items that are non-taxable, and I need to deduct non-taxable items, and I need to add back certain expenses that are not deductible. So if you look at the UAE corporate tax law, right now, those are the items that you have to make adjustments for. There are not that many, to be honest. The complexity is not in making those adjustments, the complexity in finding these numbers and making sure that we have proper accounting records. The UAE has been a ground where there was no corporate tax in the past, so maintaining very detailed records was never a requirement, but now it's going to become one. So start off with book income, make those adjustments, and you'll end up with taxable income. But from a tax accountant perspective, I don't see it the same way. I see it with the right-hand column is showing you. Yes, I'm starting with book income, but I'm not dealing with non-deductible expenses or non-taxable items. I'm dealing with permanent differences and temporary differences. And all I've done here is I've taken all my adjustments that you see on my left-hand side, and I've reclassified them to the right-hand side. That will be the exercise that will have to be conducted. And bringing back that mindset of, yes, there are temporary differences and there are permanent differences, and I have to get back into those. You'll see here some examples of permanent differences. I think that could be very useful from going forward. Participation exemption, foreign permanent establishment exemptions. So these are all adjustments where, from a tax perspective, these items of income are included on your financial statements but will not be subject to corporate taxation because of different exemptions that are provided to you. These will provide what we call permanent differences. And permanent differences are important because when we get to the disclosure aspect of the financial statements, part of it is to disclose what we call a rate reconciliation. If my book income is $1,000 and my tax rate is 9%, I'm expecting my taxes to be $90. If your overall taxes are not $90, you need to reconcile what is the difference. Permanent differences is one of the reasons why you would have a permanent difference, not temporary differences. So we've looked at permanent differences and we've looked at temporary differences. Now we'll move into, well, how do you measure deferred taxes? We talked about deferred taxes being the future consequence of recovering or settling a carrying amount of an asset or liability. So in order to compute deferred taxes, the first thing you need to know is, well, what is my carrying amount? That comes directly out of your balance sheet, or your financial statements. And what is my tax base? Your tax base depends on the corporate tax rules. The UAE has provided for transitional rules under Article 61, and those transitional rules are actually very corporate friendly. What they essentially tell you is, your tax basis on day one will equal to your book basis on the day immediately before day one. So if you look at a company that's a calendar year taxpayer, taxes will begin on January 1, 2024 for that entity. Your tax base on Jan 1 is essentially your book basis on December 31st, 23. So in other words, we are not expecting any temporary differences on day one. Excellent answer. We don't need to worry about this. But the world of tax accounting is a little bit more complicated. You find your carrying amount, you find your tax base, the difference between the two is your temporary difference. You take that temporary difference and you multiply it by the tax rate. And we'll come back to this tax rate concern in a second, and that should give you your deferred tax asset or liability. In addition to temporary differences, you may have deferred tax assets as a result of unused tax credits or unused tax losses. Make life easy, unused tax credits, you'll never have to worry about it from a UAE corporate tax perspective, simply because if you have a tax credit and if you don't use it in the current year, it is gone, it is expired. So you won't be able to carry it forward, so you will not have a deferred tax asset on unused tax credits. On the other hand, from an unused tax losses perspective, the UAE tax regime is actually very favorable with respect to tax losses, and they allow you to carry forward your tax losses indefinitely. So you will have a deferred tax asset, and the fact that you can carry it over indefinitely will be very critical in assessing, can you actually recognize that deferred tax asset? And we'll get to it. The real challenge here is not the tax base, but it's the tax rate. So, if I quote IAS 12.47, deferred tax balances are calculated using the tax rates that are expected to apply to the reporting period or periods when the temporary difference is reversed, based on tax rates and tax laws enacted or substantively enacted at the end of the reporting period. So let me pause here for a second. Have to calculate deferred using tax rates that are expected to apply in the reporting period where the temporary difference will reverse, not when the temporary difference arises. Today, I might have a temporary difference with my fixed assets. Today's tax rate might be 0% or might be 9%. But that's not what drives the element in terms of how do you calculate deferred. You have to think about this temporary difference. When will it reverse? Next year? In 5 years? In 10 years? Perfect. It's going to reverse in 2 years. No problem. In 2 years from now, what will be the tax rate as we know it today? So based on tax laws that are enacted or substantively enacted, as of today, the end of the reporting period, what will my tax rate be in 2 years from now? That is the rate that you have to use. So why is this critical? As you think about your FY23 financial statements, in FY23, taxes do not apply. Taxes will apply effective FY24 for calendar year taxpayers. So in FY23, why am I calculating deferreds? Because you have to ask yourself, if you have temporary differences today that will reverse in the future, what is the tax rate in the future based on today's laws? Either 0% or 9%. So I added this chart. This chart is not to talk about really how does tax rates apply in the UAE, but really to say there's actually complexity around understanding what's the tax rate that I have to use. Is it 0%? Is it 9%? Am I a qualifying free zone person? What if I have a consolidated group with some free zone entities, but a bunch of them are non-free zone entities? Complexity could lie from that perspective. So you'll generally prepare your tax provision on a standalone basis based on what you expect the tax return to show and the tax position to claim. So if I have a group of 2 entities, one being a mainland entity and the other being a free zone entity, the mainland entity will likely use a 9% tax rate in its tax provision, whereas the free zone entity might use 9% or 0%, depending on whether we satisfy the criteria to be a qualifying free zone person. So we talked about the concept of enacted or substantively enacted. Let me bring back this timing chart to you guys, which you might have seen in a number of our seminars and webinars. In October 22, the UAE tax law, the degree law was issued. It was only published in the Gazette, though, on October 10, with an effective application date 15 days afterwards. But in reality, it was disclosed or released to the public only in December 2022. Now, the rules are effective for financial years beginning on or after June 1st, 2023. So again, if you're a calendar year taxpayer, for you, Jan 1 to December 1, 2024 is the first year where these rules would apply, and your tax return is technically due by September 2025. Why do I bring this up? And this might be a little bit of a gossip for you guys in this morning in terms of what is happening. The accounting firms all got together on a phone call and tried to understand, well, at the end of 2022, is my 9% tax rate considered enacted or substantively enacted? And there was a discussion around that. There was a large discussion in terms of understanding what is the position to be made. And I can tell you that no accounting firm decided to release their position in public, and everybody waited until Q1 of 23 to release the actual position. You want my personal opinion? It was substantially enacted in 2020. The firm's opinions, everybody waited until Q1 of 2023. Why? Because all they wanted to see was the cabinet decision around the 375,000 dirham limit exemption. Everybody was arguing that we don't know what the first amount that's going to be exempt from corporate tax. That had to be issued in a cabinet decision, and that was issued in Q1 of 2023. Everybody knew 375 was going to be the amount, but it wasn't in an official document yet. When you look at what is enacted or substantially enacted from a tax law perspective, you really think about, could something in the rules change, or is there something missing in the legislative process for this 9% to be enacted? And the answer was no. As of 2022, the law was enacted. Let's put that behind us. In 2023, everybody agrees 9% is enacted. So 9% is the corporate tax rate that you need to be thinking about. But again, that's the law, that's the rate that is enacted today. But for you to use it, you need to first have temporary differences. So we'll get to the temporary differences a little bit later on that you might see from a 2023 perspective. I know how to measure deferred taxes now. carrying amount versus tax basis. I know what my tax rate is, 9%, maybe 0%, depending on my specific facts and circumstances. So then, can I recognize those deferred taxes? Now, move into the recognition criteria. Starting off with deferred tax liabilities. Deferred tax liabilities, in general, will always have to be recognized. Unlike a deferred tax asset, there is no concept of, is there a valuation allowance here? Can I recognize it? Can I not recognize it? Will I benefit from this in the future or not? It's a liability you have to recognize. There are 3 exceptions. The most common one, and that you'll hear the most about, is the exception around the initial recognition of goodwill. And we'll talk about, because that's an area of controversy at the moment with respect to financial statements. But in general, deferred tax liabilities, you always have to recognize. So then we move on to deferred tax assets. Because it's an asset, you're not always allowed to recognize it immediately. A deferred tax asset is only recognized with respect to temporary differences if it is probable that taxable profits will be available against which this deductible temporary difference can be utilized. And the same thing from an unused tax credits and unused carry forwards of losses, you have to consider whether it is probable that there will be sufficient taxable profits in the future in order for you to be able to benefit from that asset. We'll come back to the question of initial recognition exemption in a second, but this is important. And when I talk to you guys about tax credits and tax losses, I told you how tax credits expire if they're not used in the current year. So if you can't use them in the current year, you won't be able to use them in the future. Since you cannot use them in the future, you won't have a deferred tax asset for them. But from a tax loss perspective, is it probable that you'll be able to use those tax losses in the future? Well, guess what? Your tax losses are not expiring. So if you're not going to be able to use your tax losses in the future, I think you have a much bigger going concern issue than simply the recognition of a deferred tax asset. In other jurisdictions, it is very common for tax loss carryforwards to be limited to a period of 5 years, 10 years, or 20 years. In that case, you need to think about, will I have sufficient taxable income in the future ahead of the expiry of my tax losses? For now, you don't have that issue to worry about from a UAE perspective. But don't be surprised if in the future, a limitation could come with respect to how long you can carry forward some of these. In fact, we do have limitations around interest expense in the UAE corporate tax law. Not all of your interest expense can be deducted, and the amount that is not deductible in the current year may be carried forward for the next 10 years. So if your deferred tax asset is with respect to interest expense, you have to schedule out and make sure that you'll be able to use it within the next 10 years. Let's move into the world of initial recognition exemption around goodwill, the very hot topic right now in the UAE. Okay. As you think about your 2023 financial statements, we talked about how there should be no temporary differences because transitional rules allow you to ensure that your tax basis will equal to your book basis on day one, theoretically with no temporary differences. But when you're dealing with consolidated financial statements, upon consolidation, you might have fair value adjustments. You might have recognition of goodwill arising from a business combination. Question there is what happens in that perspective? What is my book basis? What is my tax basis? And what do I do with it? So take the example here of, simple example, business combination in 2020 occurs. It's under IFRS 3. We have to recognize a goodwill of $1,000. In 2020, we did not have UAE corporate tax. So what does that mean? And this is where you have differences of point of views, and I can tell you the accounting firms are still considering which point of view they want to take. So nobody has released officially their point of view with respect to that, and I can even tell you from a Deloitte perspective, we're still in reflection because it's a very complicated matter. I'm going to simplify it for you here, but deep down it's very complicated. The first point of view. On day one, in 2020, I'm recognizing goodwill, so I have a carrying amount of $1,000. In 2020, we did not have UAE corporate taxes. 2020, we did not have UAE corporate taxes. So one point of view is to say that my tax basis is zero. There's no corporate tax. So tax goodwill does not exist. And if that's the case, that creates a temporary difference of $1,000. What is your tax rate at that time? The 9% was not substantially enacted. Your tax rate was 0%. So that creates a deferred tax liability of zero. $1,000 of temporary difference times 0% gives you zero. Nice and easy. The other point of view around this is that in the absence of a corporate tax law, some will tell you that you have to assume your tax basis is equal to your book basis. Okay? So if we did that, book goodwill of 1,000, tax goodwill is assumed to be 1,000, creating a temporary difference of nil times 0% gives you zero. At the end of the day, the outcome is the same. Deferred tax liability is zero. But deep down, the outcome will be very different once the tax rate changes. And now we move on to the next slide where we can see that. So, fast forward, 2023, the 9% is now substantially enacted. Going back to my initial point of view number one, if I had initially said my book goodwill is 1,000 and my tax basis is zero, upon the initial recognition of goodwill, I had a temporary difference of $1,000. While my tax rate used to be 0%, it now has moved to 9%. So temporary difference is 1,000 times 9%. That technically would give you $90, but in reality, you'll go back to zero. Why? Because of the initial recognition exemption. If upon initial recognition of goodwill arising from a business combination, you had a temporary difference at that time, that temporary difference is sheltered from a deferred tax liability, even if your tax rate was to change. 0%, now it's 9%. If it goes to 15%, your deferred tax liability would remain at zero. If you had the second point of view where you said, no, absent a corporate tax legislation, I'm going to assume my tax basis to equal to my book basis, and therefore, on day one, my temporary difference was zero. Well, now that we've enacted UAE corporate tax, and now that we know goodwill will have a zero tax basis, well, you've suddenly created a temporary difference of 1,000. But that temporary difference was not created at the initial recognition of goodwill, but that was subsequently created at the enactment of the UAE corporate tax. So now you have a temporary difference of 1,000. You have a new tax rate of 9%, giving you a $90 deferred tax liability. Two completely different outcomes. And if you book that $90 of deferred tax liability, then when do you reverse it? You don't. Right? Goodwill is not being amortized, so the only time where you'll get to reverse it is if you impair your goodwill or dispose of the entity that created the goodwill. So suddenly taxpayers, UAE entities, are facing with this challenge of needing to potentially recognize, a significant amount of deferred tax liability on your 2023 financials, which, by the way, where would you book this? You're not going to book it against goodwill, which you would have done if that was back in initial recognition exemption days, or if your PPA was open. This would get booked against your P&L. So I have an unfavorable P&L adjustment that's about to hit my books in 2023 with a liability that's not going to move away. Accountants are going crazy over this, and rightfully so. But is it uncommon to see deferred tax liabilities sitting on the books forever? It is not. If I go back to this example, we talk about recognition of goodwill upon a business combination on day one. If that same business combination, instead of recognizing goodwill, would have recognized a brand name, an intangible asset that has an indefinite life and therefore is not amortized, on day one you would have had to recognize a deferred tax liability, assuming you had a corporate tax rate of 9%, and that deferred tax liability would have stayed forever. It is only goodwill that is provided with the exemption from an initial recognition, not all intangibles with an indefinite life. Meaning, from a financial statement perspective, it is not totally unusual for us to see deferred tax liabilities that will sit around forever. So that's now a huge area of concern, and I'm sure from a 23 financials, if you do have goodwill, expect to hear a lot about it from your auditor. Moving on to financial statement presentation. Now, there is financial statement presentation and there's financial statement disclosure. Two different things. Presentation. Presentation simply deals with how do I present some of these assets and liabilities. If you think about your current tax asset and your current tax liabilities, do I have to present them separately? Do I have to net them together to get to a net position and simply present my net position? Rules will say that you can only offset these current tax assets and liabilities if the entity has the legal right and the intention to settle on a net basis. From a UAE perspective, that's pretty straightforward. There's only one tax authority, being the federal tax authority. So that's easy to settle. And we're talking about corporate tax expense here, corporate taxes. You cannot net a VAT recoverable with an income tax payable. Very clear. However, if I'm doing a consolidation, and in my consolidation I have a UAE entity and a KSA entity, UAE has a payable, KSA has a receivable, you will not be able to offset them. And you would have to show them separately. I've been dealing with this for a week. It'll go away. Sorry for that. Moving on to deferred tax assets and deferred tax liabilities. Contrary to income tax receivable payable, deferred tax assets and liabilities will always be viewed as non-current or long-term, whatever terminology you want to use. You don't see them in the current. And you can only offset them, again, if you have the legal right to do so, and you have the intention of doing so. And here you're allowed to offset not just deferred tax assets and liabilities from the same entity, but could be from different entities. So it is very common, and it is actually expected, as long as your group is only UAE based, for you to be able to settle these and present these on a net basis. Income tax expense and recovery, as we all know, that has to be presented as part of your statement of profit and loss or part of your OCI. Moving on to disclosures. So, the income tax footnote will actually be very critical for you and could be actually a very lengthy one depending on your facts and circumstances. Under IFRS, what do you have to show? Mandatory disclosures include the following. Major components of income tax expense and recovery, including what is your current tax expense, what is your deferred tax expense, and what is your deferred tax expense as it relates to amounts that are originating from your current year activity, and what is your deferred tax expense related to changes in tax rates or the imposition of a new tax. So this will become critical as you look into your 24 financial statements and when you start actually accounting for income taxes from a current perspective as well. You need to show a rate reconciliation. You need to show disclosure around the changes in tax rates. You also need to show amounts and other details with respect to deductible temporary differences, unused tax losses and unused tax credits, and then you have to also show the details of your deferred tax assets. So, what you typically would see is a note disclosure disclosing what are my deferred tax assets and liabilities, but also what are the composition of those deferred tax assets and liabilities. So you will not just tell me I have a deferred tax asset with respect to my losses of $90, that is tax worth, but you'll also tell me I have an actual tax loss of $1,000. So you have to show what is your actual temporary difference and what is the deferred tax asset associated with that. So a lot of disclosure requirements is going to be needed. The biggest challenge from a presentation, from a disclosure perspective, that accountants will face is around the rate reconciliation. Because somehow, some way, these rate reconciliations never reconcile. That's where complexity will be. As a tax accountant and as an auditor, when I receive a tax provision to audit, the first thing I will always look at is your rate reconciliation. Does your rate reconcile or not? And what are the elements that are explaining the rate differences? That's how you have an initial sanity check. Will this provision give me a headache, or will this be an easy provision? So really, take time in terms of preparing a rate reconciliation. It's going to simplify things, and you'll see how it just explaining your tax provision will make a lot more sense going forward. Uncertain tax positions. IAS 12 does not talk about uncertain tax positions, yet it's a very, very popular topic. In the US, they used to call it FIN 48 under ASC 740. You can also see the language in there with respect to uncertain tax positions. First question is, what's an uncertain tax position? An uncertainty with respect to a tax position that is either has been already taken on a tax return, or you intend on taking it on a future tax return. Examples would be allocation or shifting of income between jurisdictions. So if your transfer pricing you think is at risk, or if the transfer pricing policy you've decided to take might be a little too aggressive, that could lead to an uncertain tax position. A decision to classify an entity as exempt or as a qualifying free zone person. So whether an entity is taxable or non-taxable, and you take a call that, you know what, this is a qualifying free zone person, this entity is entitled to a 0% tax rate, well, that could lead to an uncertain tax position if there's any challenges or if there's any risk in terms of the foundation that you've used to determine that you are a qualifying free zone person. Last but not least, the characterization of an income or a decision to exclude reporting taxable income on a tax return. Donations are not deductible from a UAE corporate tax perspective unless they're paid to a qualifying public benefit entity. So if you decide to say, you know what, this is not a donation, but this is a sponsorship, and I will account for it as a sponsorship and take a deduction, that could lead to IFRIC 23 is where we need to go to understand how do we treat, and how do we disclose, and how do we account for uncertain tax positions. And what IFRIC 23 will tell you is that an entity has to consider whether it's probable that the relevant tax authority will accept each tax treatment that is used or planned to be used. And the word here is probable. Two possible outcomes in your assessment. You will either conclude that, yes, it is probable that they will accept the treatment, and in that case, from an income tax accounting, you have to use the same values and the same treatment that you are using on your tax return. That's the position you've taken. Makes sense. But when it's not probable that the authorities will accept your position, your tax accounting needs to be prepared not on the basis of your tax return, but on the basis of either the most likely amount or the expected value of the appropriate tax treatment. So, simple example. We'll go to a more complicated one afterwards, or a more detailed one afterwards, but I decide that my free zone entity is subject to 0%. If it's probable that the authorities will accept that, you will do your provision using a 0% rate. If you think the authorities might challenge that, you will not be able to use a 0% rate, and you have to think about what is the tax rate that we would have otherwise used. Is it 0 or is it not? In conducting this analysis and this assessment, you have to assume that the tax authorities has knowledge of every fact, full knowledge of all the facts. and that the tax authorities has the right to examine all the values that you have reported to it. And that assessment is not only done from a technical merit perspective, but also from with respect to what is the amount presented on the tax return. So we talked about probable. What does probable even mean? IAS 12 does not define probable. IFRIC 23 does not define probable. You actually have to look at IAS 2037 to get the definition of probable. Probable essentially means more likely than not. Talked about if it is not probable that the authorities will accept your position, you have to revisit your position based on either the most likely amount or based on the expected value amount. What is the most likely amount? The most likely amount is essentially the single most likely amount in a range of possibilities that the authorities might accept. Whereas the expected value amount, that one is a sum of probability weighted amounts in a range of possibilities. One is a fixed number, the other one is an average of a number of possible outcomes. So let's look at an example with respect to this. Assume an entity decides to take a deduction of $1,000 that is not a timing item. This is really a permanent difference. And as a result of that, they're going to get a $250 reduction in their income taxes on the assumption of a 25% tax rate. You ask yourself, is it probable that the authorities will accept that? And you say, nope, they're likely going to challenge it and they're not going to accept it. So you define a possible outcomes. They will accept the entire $250 reduction, 22% likelihood of that. They will only accept a $200 reduction, outcome is 30%, the probability of that is 30%, 150, 100, and 0, each of them having its own percentage of what's the probability of this occurring. If I were to use the most likely amount approach, I look at all of these outcomes and I say, which one is the most likely to occur? The one with the highest probability is 30%, $200 deduction will be allowed. As such, I had a $250 reduction on my return. They'll likely only accept $200. I would need to book an uncertain tax position of $50 in this case. In the expected value amount, you would actually look at all of these outcomes and say, on average, based on their probability of each, the authorities will likely accept $165 of a deduction, where I claim $250. As such, I would need an uncertain tax position of $85. Which of the two methods you use is not an accounting standard, but it's a question of facts and circumstances. It depends on what type of issue you're dealing with and what is the most appropriate one to be using based from a professional judgment perspective. This is a quick overview and a recap of what IAS 12 is to present to you and what IFRIC 23 talks about with respect to uncertain tax positions. The current areas of concerns that we need to think about and that we will address in today's session later on are the following. With respect to your FY23 financials, what impact does your UAE corporate tax will have on those 23 financials? And it's not just an impact from an income tax perspective. It's also an impact from a transitional rules perspective. As we said, your opening tax balances in 24 will equal to your book balances of 23, which brings a much higher importance in making sure that your ending balance sheet of FY23 is a solid one. There are planning opportunities around that to make sure that once FY24 kicks in, you are able to shelter certain gains and losses, and you are able to manage your overall effective tax rate. Can companies benefit from the initial recognition exemption of goodwill? We talked about that. Controversial views, two different point of views. So speak with your auditors to see where are they headed in terms of what's their point of view with respect to that. What is the tax basis of assets and liabilities? What are the deferred tax impact? Does that have to be accounted for in the P&L, assuming I have a deferred tax liability? Do I account for it only in a quarter? Do I account for it at year end? So these are all things to be thinking about. Moving forward, what do we do with provisions? How will these be accounted for from a tax perspective? The UAE corporate tax law is silent with respect to provisions at the moment. Does silent mean that they simply accept it? Or does silent mean that changes will come? More cabinet decisions will be released? And really, what is the evolution of corporate tax law? Today we have version 1.0. What will happen tomorrow? What will happen when Pillar 2 will kick in? Pillar 2 being the global minimum tax rate of 15%, for which the UAE is a member of the inclusive framework. All of these are things to be considering, talking about, discussing with your tax advisors, discussing with your auditors, and discussing with your board. Thank you very much for having me, and I hope you found this session useful.
Thank you, Basil. Thank you, Basil. I will do it from here because we have less of XComs here. You have any questions you can ask. We'll take only a couple of questions for now. And since we have a panel discussion, we'll request Abbas Saab to take other questions from the panelists along with him, with the audience as well. But we'll take a couple of questions now from the audience. Anyone who wants to ask anything on IS 12? No questions? It's pretty clear. There is one question. I can see one hand going up.
Basil, your presentation reminds me of my professor, so commendable efforts from your side. Thank you very much. Basically, there's a situation. There are a group of 9 entities. They will be taking individual tax registrations, but simultaneously they prepare the consolidated financials as well. Now, when I see the standalone financials, a cost approach is followed. And for the consolidated financials, they follow fair value based accounting approach or method. Auditors are fine with it. So there's a difference in the accounting method. One is cost at standalone, and one is fair value at the consolidated level. Now, a unique situation will come, and one of the item would be the immovable property, which is a qualifying immovable property as per Ministerial Decision 120. Now we have an option to exclude some gains based on market value as on the first day of the tax year. So for the purpose of recognition and measurement in the consolidated financial statements, which method I should be looking at, the cost method or the fair value? Because my answers or the disclosures will change depending upon that.
That's a really good question. Thank you for that one. So when you look at consolidated financial statements, it's a little bit more tricky. Your carrying amount in computing temporary differences has to come from your consolidated financials and not your standalone financials. Your tax basis amount, however, has to come from your tax return. So if you're going to file a tax return, and tax basis is identified generally on a standalone basis, so your tax basis will come from your cost method in your case, because your standalone is on a cost basis, whereas your consolidated is on a fair value basis. So you will have a difference there from a temporary difference perspective. And that temporary difference, then comes the question as to do I use a 0%, 9%, because it's probably a qualifying immovable asset? The qualifying immovable asset regulations, the way I would see them, is more of a permanent difference and more of a tax holiday, as opposed to an item that would impact your tax rate. Because I think the proper answer is 9%. The proper answer is that your fair value could change. And yet, you know, for you to benefit from the shelter of that gain, you have to actually dispose of the asset, which you might not end up disposing of the asset as well. So because of that uncertainty, it would be more appropriate to use the actual corporate tax rate today, should you and when you benefit in the future of of the qualifying improvement of the qualifying immovable asset shelter, then that would give you rise to what I would like to call a permanent difference. But as of today, I don't think you'd be able to rely on that to say my tax basis will be fair value.
Sorry for this. Arisa, 1 second.
Hi, Basil. It was a very nice presentation and gone through its refreshing session. I have basically 2 questions. First, related to the IFRS applicable to the SMEs and the main entities. So how the SMEs can make their accounting procedure in a simplified way so that these jargons can be avoided or simplified? One, that is the first question. Second, from the investor's point of view, where the annual reports, what should the investor should educate themselves to understand the complexity about these deferred tax liability provisions to exclude in their thesis or include in their thesis? Can you please give some insights about it?
Sure.
Thank you.
On the first question, from an SME perspective, IS 12 is to be applied the same way, unfortunately. There's nothing, there isn't any simplified IS 12 procedure. In other accounting standards, certain entities may apply the current tax approach, where you would only book current taxes and you would not book any deferred taxes. Unfortunately, from an IS 12 perspective, that is not available to you, even if you're an SME. So adoption of IS 12 is an adoption in full, including deferreds, which is not I guess, a favorable answer, if I can say it that way. From an investor's perspective, I think that's a really interesting question. Depending if you're dealing with a public entity versus a private entity, from a public entity, I think the MD&A discussion is going to be a critical one, because the MD&A discussion is going to be one around the introduction of corporate tax, what are the uncertainties that are being provided, and how is the company going around it. So it is important to have proper disclosure in there and proper analysis in terms of what is management thinking. Obviously, there are lots of gray areas right now. Again, going back to the areas of provisions as an example, IFRS 9, expected credit loss, how do you treat that? If I overtook a provision in 23, it gets reversed in 24, am I suddenly paying tax on the reversal of a provision? It doesn't really make sense from a tax policy perspective. So you need to be able to inform investors about all of these decisions that you're taking and what the landscape looks like, because it is a complicated landscape. And as simple as as simple as the corporate tax law might be, or the UAE is trying to make it as friendly as possible, sometimes overly friendly leads to complexity. Just as similarly, basically that's what we're seeing at the moment. From a private investor's perspective, I think it's important to disclose really the one-time impact related to IS 12. So really, if you're recognizing a deferred tax asset or liability today because of temporary differences ahead of FY24, that's a one-time hit. Really outlining that this is a one-time isolated thing, and really outlining when do you think that could reverse. Goodwill is not going to reverse, so outline that so that when they see that liability sitting on your balance sheet for years and years, it is not a shock or a concern, oh my God, I'm going to have to deal with this in the future. And it's purely an accounting standard
IFRS International Committee 23 does not define probable. IS 37 defines probable, but we don't need any probability. We are sure that he has done a beautiful and a great job of defining IAS 12 to us. Give a round of applause to the speaker, and will request chairman and vice chairman to join me on the stage to share a token of love and appreciation on behalf of all of us with the speaker. Mr. Bessel. I love the way you were coughing, but still you ensured that you do not give on the learning. That was best part, Mr. Bessel. I can see you are not good doing, you were coughing. We were worried about you, but you were tremendous there. Thank you very much for sharing your knowledge with us. Moving on. First thing first, we have Dr. Sunil Manjrekar, President of Gulf Maharashtra Business Forum among us. And thank you, sir, for joining us. On our request, he came in. Thanks a lot for that. One more thing which Chairman said in his address is that both the study tours which were organized, yes, committee supported, but one person who was responsible for it was The reason that we could do it because he loves traveling and he himself approaches and says, I will take care of it, I will support you. And that's why we want to appreciate him for his contribution. Can we have C. Amit Khaitan on the stage for sharing a token of love, for doing all the hard work in arranging study tour? And can we have chairman and vice chairman with on the stage to felicitate with him for his support? Sir, study tours are done by the chapter, but sometimes we need support from members. He came along and said, I will do all the organization for you. Give a round of applause for Amit Khaitan. Sustainability refers to the practice of meeting our own needs currently without compromising the ability of future generations to meet their own needs. We got access to oxygen, water, food, 4 seasons in a year, but the way world is progressing, there is an increasing alarm that these may not be available or easily accessible to future generations. Let's take a pause. Let's think. If we were living in a world without this access and availability, I'm sure we will have jitters and it looks scary, feels miserable. Our future generations may have to face this if we do not adopt sustainability. Now we know the importance of it, and we have Mr. Kabir Dhawan with us to enlighten us on the strategies for sustainability. Before I request Mr. Kabir to take the stage, I will request our treasurer, C.A. Rishi Chawla, to formally introduce our speaker to all of us. C.A. Rishi Chawla, for you, a round of applause for our treasurer, C.A. Rishi Chawla.
Dear members, distinguished speakers of the day, ladies and gentlemen, a very good morning to all of you. Can I have raise of hands, how many of us believe sustainability is important? All of us. We all love sustainability, but we may not know the right strategies to be a sustainable person. To talk about this important topic, we have our next speaker, Mr. Kabir Dhawan, who is going to talk about strategies on sustainability. A brief profile about him is he's partner in the business consulting division of Grant Thornton. He has deep focus on transformations, people and business efficiency, especially on handling complex assignments. Over last year, he is increasingly involved in ESG and sustainability reporting. With a background in science, he did SEMA as an accounting degree and also did his executive MBA from London Business School. He has led, planned, and delivered over a dozen complex client transformation assignments, and over the last 1 year, he has done various ESG specific assignments in UAE. So without taking much time between you and this amazing speaker, please join me with big round of applause to welcome Kabir Dhawan on the stage, please.
Morning, everyone. How are you doing? Thank you for giving us your time this morning. We're going to talk a little bit about sustainability. My contact details are on the QR code, if anyone wants to grab that, just while we do a quick poll of the audience. I wanted to first ask, who works with an organization that has a sustainability strategy today? Could you raise your hands, please? So not many in the room. But that's okay. Maybe that will change after this morning's session. Who thinks the organization they work with does well against environmental targets? You raise your hands, please. A few? Okay. Who thinks the reporting requirements around sustainability is going to increase over time? Okay, excellent. So that's 80–90% of the room. And then final question. Do you think this will be a responsibility of the finance function or the finance organization? Please raise your hand. Okay, very interesting. Brilliant. So what we're going to cover today is a quick introduction to ESG. We are going to touch very briefly on the recently released standards. And then we're going to talk a little bit about sustainability strategies. I think these are all very important topics. So what is ESG? So ESG is a framework used to assess an organization's business practices, performance on various sustainability and ethical issues. It provides a way to measure business risk and opportunities in those specific areas. It helps companies provide a holistic picture to stakeholders and investors in terms of what they're doing on ESG. It helps companies integrate their values and their practices together, which is very, very important. And finally, it allows a pathway for transparency to external stakeholders. A lot of what we talk about when it comes to ESG comes from one main source, which is the United Nations Sustainable Development Goals. This is the heart of ESG. That is how I would describe it. And it talks about a number of priorities, 17 priorities, which feels like a lot, but each of these topics are very weighty, important topics by themselves. Things like eliminating poverty, ensuring access to clean water, taking action on climate change, making sure that quality of education is consistent and available to all. These are really important topics for us as a society. Now, why is it important to adopt ESG practices? We did some research, and we've got a few data points on here. So the first is that only 50% of organizations believe they perform efficiently against organizational targets today, which to me is lower than what I was expecting when we set out to undertake this research. 74% is the level of growth in regulations relating to ESG over the last 4 years. And then finally, 88% of consumers believe that they would actually be more loyal to organizations where there are better ESG practices or support for ESG practices. Now, this is what the research shows, but let's also look at the practicality. Investors are using ESG to assess their investment choices. Lenders are starting to use ESG to work out how much to lend and at what levels and whether this is the best use of funds. You have cost impacts from not complying with regulation, and you have talent retention and employee value propositions, which are also linked to this topic. Employees tend to stay with organizations a little bit longer if they believe in the values and the practices of that organization. Now, I said that the SDGs, the Sustainable Development Goals, is the heart of ESG. And while that is the case, there are dozens of pieces of regulation, standards, guidance that are created and issued worldwide. And it's very difficult sometimes to think about the guiding principles attached to ESG. Where should I go? What should I look at? How do I start? Because the Sustainable Development Goals are amazingly important goals, but they're not really giving you the guidance on how to execute, because they are goals. So you then have a number of different factors playing in, and I just wanted to touch on a couple of them as part of this, the ecosystem. First, you have COP28. This is the 28th annual session, which is really focused on climate change, and that is happening here in the UAE later this year. You have the Sustainable Accounting Standards Board that provides very granular guidance on a sector-by-sector or industry-by-industry basis. So specifics around financial services, around healthcare, and so on. You have the UAE Ministry of Climate Change that also produces and distributes guidance and regulation. You have the GRI, the Global Reporting Initiative, which is one of the more detailed sources that structures how to think about these ESG topics, and a number of other areas. And all of it links together. And I think one of the really interesting things, and we'll touch on the standards, S1 and S2 in just a moment, is that this is now the first time we're starting to see elements of convergence. At least from a disclosure and reporting perspective, we're moving towards a more unified way of talking and reporting on these topics. In the UAE, can I just, again, get a quick show of hands? Who here works for a listed organization? We have a few. So listed organizations are required to produce a sustainability report, and it needs to be done within 90 days of the end of the financial calendar. There are other regulations applied to the financial services sector, where banks need to do something equivalent, but my estimate is that after COP28 concludes, we may start seeing other sectors and other reporting requirements. You may have to start thinking about this because your business might be in scope of these reporting requirements. And we'll very just quickly touch on a sustainability report and then move on to the standard. When we talk about sustainability reporting, what is actually included in that? While there is no global standard reporting package that everybody can use as a template, there are lots of pieces of guidance around the topics, but typically you break it into three: the E, the S, and the G. On the environmental side, you would talk about waste and water management, supply chain efficiency and usage, electricity, carbon footprint, emissions, and so on and so forth. On the social side, there's the health and safety, human rights, CSR, data privacy, anti-corruption, and so on. And then on the governance side, you have the pieces around the board of directors, the committees, how you effectively manage, control, provide transparency, and so on. And when we look at this, I think typically the environment piece is one of the hardest for organizations to get to grips with, because this is not something they're used to doing. Who here has ever tried to estimate carbon emissions from their supply chain? I would suspect very few people in the room, but this is going to be part of those requirements going forwards. So I think the environment part is actually one of the most challenging. Social, I think, is actually quite easy to capture and present activities and results around. And then governance, it's one of those situations where if, as an organization, you have strong levels of governance, things are well documented and defined, it is actually quite straightforward. But if governance is not a priority in the organization today, maybe it's not documented, maybe it's not described in the best way possible, that can sometimes be a bit more challenging as well. So let's talk very briefly about the standards. So on the 26th of June, 2023, the International Sustainability Standards Board issued the first two IFRS Sustainable Disclosure Standards, which is S1 and S2. These are the first ones that have been issued by the ISSB. We are not expecting that to be the last. This is the start of a journey. And effectively, S1 is focusing on sustainability-related risks and opportunities. And S2 is focusing on the climate-related risks and opportunities. Now, within each of these, there is a very large focus on sustainability governance, strategy, risk management, metrics, and targets across both sustainability and climate-related items. In terms of how we got to this position, the ISSB was founded, I believe it was constructed in 2021, and in 2022, the draft for the standards was released, including comments effectively globally. They actually turned this around very quickly, because towards the back end of 2022, 2023, they were getting the standards in a shape where they could be released to the public. And this actually happened this year, so in June. Now, what does this mean going forwards? Well, the standards highlight that the first effective mandatory reporting period will be on or after January 2024. So we're expecting to see the annual reports starting to be produced by 2025. Companies can actually report against this earlier if they would like, but I don't think many organizations have opted to take that up just yet. When we looked at the standards, I looked at it from an advisory perspective, not an accountancy perspective. And there are some areas that can be a little bit more challenging. And from my perspective, these are some of the areas which I think organizations will have to spend some time grappling with. The first is around risk management. So organizations now need to get into a position where they can identify, assess, prioritize, monitor, and manage climate and environmental related risks. This is a new field for a lot of people, and there will be a degree of upskilling that needs to come from this. But tied to that, there is also the need to assess how resilient an organization is in terms of its strategy, how that interfaces with the business model, the operations, and how you pull all of this together. We will talk about how to operationalize this in a few minutes. On the governance side, as I sort of hinted at earlier, if you're with an organization that is actually strong on governance today, this will not be difficult. If your organization doesn't give the right level of focus to governance, this might be a little bit more challenging because you suddenly have to open up the visibility around a lot of these topics externally. And then the third part, which I think is actually the most challenging, is around emissions tracking. So being able to identify, measure, and then take action on carbon emissions across your organization is not a straightforward task. I've been involved in a number of these projects over the last year and a half, and it's always a step change for organizations because most people do not know where to begin. But again, we'll show you a framework that might help a little bit of the thinking. So, on to what we do about all of this. How do you integrate ESG into your organization? How do you make your life easier when it comes to managing the disclosures and the reporting requirements? Typically, it starts out with developing an ESG strategy. And these are the 5 steps that I would set out, which are fairly high-level steps, but we'll spend a moment going through each of them. To start out, develop your ESG strategy. Work out what are the material areas you need to align to in terms of your sustainability focus, and document that vision and those actions as you would with any corporate, organizational, or business unit strategy. Once that is in place and captured, start out by activating your ESG department or team. Some organizations choose to create new roles, set them up, make a new team, and give them the responsibility. Others distribute the responsibilities around existing team members. Typically, you have risk, finance, compliance, procurement, HR, all having a share of those responsibilities. But the key point is to actually distribute the responsibilities for delivering against the strategy. Step 3, make it easy to collect the data that you need to collect to report and handle the disclosures. This could be defining templates and the frequency around when those need to get populated so that at the end of the year, when you do need to prepare your sustainability report or disclosures, all of that data is immediately available to you and you don't need to go around the organization gathering everything last minute. The 4th step is to start thinking about and setting up your greenhouse gas emissions tracking. This, as I said before, is a little bit challenging sometimes, but typically you can handle it in a number of different ways. I think if, as an organization, you're strong on the manufacturing side of things, this is typically a little bit easier. If you're more of a services or trading organization, you really have to focus on the supply chain and start understanding your supply chain and the emissions attached to that. And then finally, wrap all of that together in ESG reporting. Looks simple when you just set out the 5 steps, doesn't it? But let's dive into the first one, because this is the hardest piece, which is really developing the ESG strategy. So we're going to go one level down and focus on ESG strategy development. This is the approach my team and I use when we work with clients. I'm happy to share it because we find this to be the most effective way. So we're going to step through it, and then we're going to dive into 2 of the more complex areas, which will be step 3 and step 4. So how do you develop a strategy? We try to keep it simple. This is not really any different from any other form of strategy development. Work out what you have today. What does your organization do today? Do you have social, charitable activities, contributions? Do you have benefit that you give back to the community? Do you have waste minimization activities? Look across the organization and work out what you do today. And that is your starting point. That is your current state. Then start connecting with your stakeholders. These could be internal, these could be external. Speak to your board members, speak to your shareholders, speak to your investors, your lenders. Ask them, what do you need to see from us in terms of ESG priorities, so we can put it in our strategy. Step 3 is what we call a materiality assessment. This is an analysis to work out what is important for us as an organization, and we'll dive into this in just a moment on the next slide. Once you understand what's important, once you've understood what your stakeholders are asking for, you can actually combine all of this and start structuring the areas and the priorities. Then finally, implement. As I said, it's your standard approach to strategy development. But let's dig into 2 of them, which are a little bit special sometimes when it comes to ESG. So we'll start with the materiality assessment. So materiality assessment is that 3rd step. So you've worked out what you have in your organization, you've spoken to your stakeholders, and now we need to do a materiality assessment. This is just a complicated name for working out what is important. And typically, you would take a list of topics that have come out of your discussions, and you would prioritize them. Impact, effort, or importance and impact. You can decide what the axis is, but ultimately take all of the inputs that you have received and work out what sits in that top right corner, because that's the most impactful, the hardest stuff to deal with, and these become your strategic priorities. As you go through this process, you kind of have the 4 steps over here. You've identified the topics. Again, you can go back to your stakeholders once you've done a first pass and say, this is what I think should be in my strategy. How do you feel about this? And get that stakeholder engagement going, and ultimately end up with a list of things that are going to sit as the core of your strategy. Once you have that, you need to create the initiatives against it. Again, this is a framework that I tend to use with my clients, which for me is a straightforward framework because it captures the different types of stakeholders, and it also captures the different areas of focus. In terms of clients, these are clients of your organization. What do they want to hear about from your ESG strategy and your ESG practice? The second is employees. I think most people here will have a good understanding of what is important to the people in their organization. So this part of the framework is really capturing all of those important thoughts. It's all of the activities that your staff do as well. if you have outreach programs, if you have things that give back to the community, if you have 2 charitable days a year that employees can take to go and clean up the beach or work with a charity, or any of these sorts of topics are great ones to start capturing there. You then have supply chain. Supply chain is the difficult one because this is where your emissions come from. But you can almost break it into 3 steps. Start with visibility, then move to reporting, then move to action. A very quick win for anybody in this room is go and ask every one of your suppliers, do you have an ESG strategy? How do you think you perform against environmental targets? And then document that. And at the end of the year, you can look at that and understand that 60% of my supply chain has an ESG strategy. That's a good thing. Once you have it, you can then set a target. You can set action around that and say, you know what, by next year, I want 65% of my supply chain to have an ESG strategy. Now, this is not solving things, but it's moving things in the right direction. But you might start thinking about your processes at the same time. Do I need to have a evaluation criteria for my procurement team where a percentage of the score I give to vendors is based on ESG components? So this is where it starts getting more interesting, and you can actually start driving change. And then ultimately you have the action. So what are you going to do about it? And with a lot of these topics in ESG today, there is no central authority that is telling you, you need to go from X percentage to Y percentage for this KPI. As an organization, you are typically only competing against yourself at this point in time. So my perspective on this is that if you are setting ESG targets, as long as you are demonstrating incremental progress against them, you are doing the right thing. So that's supply chain. Community, we've already touched on a little bit. Community can mean many different things. It could mean the environment around which the offices are based. It could be how your people connect into the broader community. It could be giving back. There's a number of different ways you could look at this. And then finally, regulators. There is more and more regulation coming, even in the UAE. Our expectation is that following COP28, there will be a number of commitments that get made, both in the UAE and globally, and these will ultimately flow back to regulation, which will then flow back to the organizations. So we are expecting this to get more complex. But if you take these points, knit together your strategy, use a framework like this or similar to this, it's actually a lot more manageable to start articulating how you tackle these points. So just to have a very brief recap then of what we've covered. ESG is becoming increasingly important for investors, customers, lenders, other stakeholders. It's a way of assessing how an organization is operationalized and how they really link their values to their operations. The introduction of the S1 and S2 standards are an important step in driving convergence between all these different standards, goals that connect together, and linking it to regulatory reporting requirements. We're expecting there to be an increasing set of requirements come through. And then finally, organizations should really be focused on starting to develop their ESG strategies. Even if it's a light strategy to start, these requirements are not going away. If anything, they are going to become more and more complex over time. And I think a good proportion of that will always be landing with finance professionals because you are the custodians of the numbers. And a lot of the reporting ultimately comes through the numbers. So I think that's it. Thank you for your time. I think we can take a couple of questions.
Anyone has any questions on ESG? Couple of questions. I can see one hand going. Naresh, one for Naresh, you go. Mic pass kiya jaye, please.
Hi Kabir, it's marvelous cohesive framework presentation. My question is about the responsible banking part. If you can reflect a bit on it, it'll help. Thanks.
So I'm working with a couple of banks at the moment on this particular topic. And what we have found is that you really need to start integrating a lot of frameworks, particularly for financial services, because I think this is one of the areas that typically has a lot of regulation. And you're seeing more and more added, but now coming from the ESG side. When we look at this, we don't typically just focus on certain principles or certain regulation or certain standards in isolation. What we've actually been spending a lot of time doing with our clients is almost integrating all of these different standards and requirements from 8 to 10 different places into a master framework and ensuring that that addresses it. And responsible banking, I think, typically falls into that category. It sits in a number of different places. I think the SASB also touches on this in the financial services piece. Ultimately, I think it's about bringing all of it together and creating that master framework.
Thank you for that. Any other questions? Yes, sir. Please go ahead.
Thank you, Mr. Kabir. A nice presentation summarizing ESG. Do you think that still there is a lack of seriousness when it comes to the ESG and sustainability, be a Paris Agreement? You know, there's a lot of greenwashing going on still, and how do you think that the whole pyramid will be covered? Because there are only two regulators. One is SCA, one is the Banking Regulation Central Bank. That's it. They can only regulate two, let's say, you know, which is very small. So how you think that it's going to be? Because voluntary will be greenwashing. If it is going to be mandatory or punitive, like, you know, how you regulate the traffic by the, what is your view, like how it is going to be, like, you know, the part and parcel of the whole economy as a whole?
I think that's a great question, and actually one I've been discussing with my colleagues quite recently. And I think the best way to answer it is to look at other regions that started the ESG journey a little bit earlier. So if you take various parts of Europe, they started in the same place. They said, here are the standards, and all you need to do today is pick 3 out of 7 of these and then talk about up to 10 of the sub-bullet points. That's how they started. And then over time, that became more and more rigorous to the point at which they had to actually talk about every item in the framework and every sub-bullet point. And if they didn't do something in it, they would say, this is not applicable to me. But at least they forced the conversation around every one of the points in these GRI frameworks. The step that happened after that is now assurance. So previously, the ESG reports and the sustainability reports didn't have an assurance component. There was no requirement to have your report assured. You could go find like a 2-man consulting shop, pay them whatever they asked for, and they could write whatever they want. And no one would have any reason to come and challenge them. But then you had the assurance component introduced. I think the UAE today is early in its journey, but I have no doubt that assured reports will become mandatory in the very, very near future. And I think this is one way of addressing the greenwashing point. The other way is actually requiring organizations to be very comprehensive rather than letting them pick and choose which areas they want to touch on when it comes to ESG and sustainability reporting. So I think between the two of those, you will counter elements of greenwashing, but I think it's still a challenge, not here, this is a challenge everywhere, because until you have those stringent requirements and controls, there will always be elements of greenwashing.
Perfect. Paris Agreement is an achievement. That is what Rajesh is saying. Achievable.
I won't comment on that because I think it's above my pay grade. But I think it's important and it sets a direction for everyone to move towards.
So let's wait for the future. The last question of the day on your right side.
Hi Kabir, it was a nice presentation and the new topic I have understood this. My question, I think continuation of this gentleman's question is related to the voluntary implementation of ESG regulations. How an organization, SMEs or the listed one can go ahead. What are the incentives? I mean to the bottom line of the financial statements where they can get the benefit of incentives so that the owners or the shareholders can force the management to go ahead with that regulations. Can you please give that highlight? Also, the question is related to the who is in the world, which country is in the pioneering to implement the ESG strategies, and if their economy has grown their bottom line. Can you please give some insights about it? Thank you.
So let me answer the second question first. I think it's not about a specific organization. I think it's actually industries. So if you look at certain industries, some have made much greater progress than others. So oil and gas, energy, because of all the energy transition, and financial services, I think are some of the ones that are probably a bit further ahead. And if you want good examples of what good looks like, they are probably very strong starting points. In terms of the benefits of voluntarily developing an ESG strategy and what that means for SMEs and so on, I think it goes back to the point at the start of the presentation, which was the investors, the lenders, and the employees. Organizations that have an ESG strategy in place and they take it seriously and they take action against it, will find that it's easier to get funding because these are things that are actually assessed by lenders today. And they will find that it's easier to attract investors. If anyone is thinking about an IPO, for example, there are some very material requirements around ESG and sustainability reporting exactly for that reason, because investors care about this. They want to deploy capital to the areas that fit with their investment thesis, profile, values, and desires.
Please give a round of applause for Mr. Kabir. I love the way Kabir took it in such a calm way, the entire presentation. He started with the question, and at the end of the slide, he answered it. Yes, finance will be having increasing responsibility for sustainability with IFRS coming in. Thank you, Kabir, for the taxation. We love the sustainability part of it. Can I invite Chairman, Vice Chairman, and our Treasurer Rishi on the stage for sharing a token of love and appreciation on behalf of all of us with Mr. Kabir Dhawan. अब्बास साहब कहीं मत जाइएगा अभी हमको पूरे पैनलिस्ट चाहिए आई नीड ऑल द पैनलिस्ट एंड रीजनल डायरेक्टर and all the speakers and XCOM to come on the stage for a group photo. All the speakers as well as entire XCOM, Regional Director Prabdeep Baweja, can we have on the stage for a group photo, sir? You are also a panelist, please come. मैंने बोला था अब्बास साहब, we will need you, please come. Will request everyone to be there. I will take this opportunity to unveil the newsletter for Q1. Rishi, can you help with newsletters for the Q1 to be given to all the panelists? I cannot see any more of the past chairmen here. So it's time to unveil our newsletter for Q1. We have already discussed the progress report of how we did in Q1 in our last event on 8th of July. Today, we digitally release the newsletter of Q1, which will be available to all the members on our website for their reading. We will be sharing the link. These are few copies only for unveiling purpose because we want to promote sustainability. We request members to share the link of the newsletter with friends who are still thinking to become a member, and in this way, we can create awareness about ICI Dubai chapter and what we do to others members who may be unaware, but if we share this link, they will understand what exactly as a chapter we do. And with this, we go with the unveiling. A round of applause. Thank you all. Finally, we have reached the last session of the day, and always the best is saved for the last. Now it's a panel discussion, an interesting one, where our own moderator, our past chairman, ever young, ever melodious, for whom music is very close to his heart, C. Abbas Ali Mirza, he will moderate a discussion between four of our panelists. He's a multi-talented personality who is not only blessed with melodious voice, but also has authority on subject IFRS, which cannot be challenged. He has also served for over 70 years as an audit partner with Deloitte, including as the managing partner Deloitte LLP DIFC office. And he has also been declared as Deloitte's IFRS leader for the Middle East region and has featured as IFRS specialist on Deloitte's globally renowned international accounting website. He has served as chairman of 21st session of ISAR. He has also served as a chairman of Dubai Chambers Auditors and Accounts Group. He also served as president of IBPC, and he has authored 15 books. He is the only person in the world who has been given more than 24 hours in a day because he has done so much and achieved so much in life. I can go on and on, but I guess I will stop here and will request Mr. Abbas Ali Mirza to join me on the stage as moderator of this panel. Give a round of applause to multi-talented, dynamic leader and our own past chairman, CA Abbas Ali Mirza. Mr. Abbas to take his chair as a moderator of the session. Moving on, we have another well-renowned name, and we take proud as he is also one among us, who has gained invaluable international exposure, having worked in Dubai, Malaysia, and USA. He has worked with renowned companies like Deloitte, EY in past. He has also served as ExCom member of ICI Dubai chapter in committees of 2011 and 12 and 12 and 13. Of IC Dubai. He is currently working as a partner in Premier Brains. He is none other than our own member, CA Rishi Agarwal. We'll request Rishi Bhai to join me on the stage as a panelist with a smile. I cannot see that smile since morning, sir. Panel discussion, you can always smile. Please come. Another panelist on this panel is a seasoned advisor at board level on complex matters which typically require multifunctional solutions and involve transformational change. M&A, business restructuring, due diligence are his area of expertise. He has worked as partner with Ardent Advisory in past, and currently he serves as head of deals and restructuring in KPMG. He is none other than Shahrukh. No, not Shahrukh Khan. We know he is not into M&A. But this person has been kind enough to accept our invite at the last minute and come in here from Abu Dhabi in the morning. From 6 o'clock he reached here. 6 o'clock he started from Abu Dhabi, he reached there. We need to give him a round of applause so that we can say this is ICI Dubai chapter. Mr. Shahrukh Dumeshia, please come up on the stage. We'll request other two speakers who has already been introduced, Mr. Basil and Mr. Kabir to join us on this panel to complete the panel. And now, Abbas sir, it is over to you.
Good afternoon to everyone. I think I can say that it's almost afternoon, but the main thing is that we're all here together and we've got a great eminent panel here sitting next to me on either side. I'm so privileged to be part of this panel discussion as a moderator. Must thank the chairman, Mr. Hari Kishan Saab, for his very proactive way of getting the panel discussion. You will not believe it that even as of yesterday, we were not completely having the complete panel. And as of this morning, I will not name who, but one of them canceled. And then at a huge request, he had to reschedule his meetings. So this is a very dynamic panel, I should say, and must thank all of them to have somehow accommodated and been here today. Let me start with my friend Shahrukh Damusia from KPMG. He and I have go back many years. And so Shahrukh, since you are the expert on M&A and restructuring, just taking cue from where the market cap of the different stock exchanges are going. The New York Stock Exchange, as of January 2023, was about $22.649 trillion. That goes hand in hand with the US GDP of $25.46 trillion, which is the world's largest economy. So they say that if you look at the market cap of a stock exchange and you compare it to the GDP of the country, they are pretty much hand in hand. So that means the M&As and the IPOs have a huge impact on the way that a country will grow into the largest economies. So keeping that in mind, would like to ask you, from your expertise, from your experience, how is the M&A activity and what is actually not very conducive to that in the Middle East?
Wow, that's a big question. How is the world economy going to go? Let's try and answer that in a simple way. Look, I mean, it's obvious that we have, in the past 3 or 4 years, come through very difficult times. COVID has been a massive stress on all economies. As we came out of COVID, there was a period, certainly for M&A and for markets, which saw a very sharp boost in sort of 21, maybe even in 20. But really, globally, all that slowed very, very rapidly. The overhang of COVID, the amount that these economies, the US, Europe, everywhere in the world spent as a hangover from COVID, supply chain issues which resulted from, I call it sleepiness. We suddenly woke up from a slumber, we didn't wake up quickly enough, things didn't work, things still don't work, right? However, pent-up demand led to a very sharp increase in M&A, obviously, after nil in the last 2 years in 21. However, the headwinds in the rest of the world for M&A have slowed it down in the last year, certainly. We, in the Middle East, are probably the only exception. Our volumes jumped up in the Middle East from, well, look, I mean, during COVID, it was virtually nothing, 200-ish deals a year, right? It sort of came up to about 300 deals in 2021 and rose very sharply to about 600. In both, actually in 2021 and 2022, it remained at about 600. Okay? At the same time, both of our exchanges woke up from the slumber. In the UAE, there had been no IPO in 2020. In 2021, there were 4. In 2022, it jumped up to 12. Saudi, being the bigger powerhouse, immediately recovered after COVID. In 2020, it actually still had 4. 2021, 11. 2022 jumped up to 16. And over there, the second market, Nomu, has exploded, right? So we in this region are probably an complete exception to global trends. What's driving it? Well, oil remains high. Therefore, both the largest countries, which are the main drivers of M&A activity in the region, have done very, very well. The governments both have significant agendas and both have very, very significant energy and resource to put into it. So in our region, where we are, we're quite lucky in that M&A activity and the markets have remained relatively strong. We're the exception. And as I look into 2023, it continues. So in quarter one, the activity in terms of the public markets has remained strong. In the first quarter, we had 10 IPOs. Confidence remains very high. Actually, there is plenty of money. The problem is the assets. So I think we in this region are an exception in the world in currently high activity and a dearth of assets. Abbas, does that help?
Thank you, Shahrukh. I'm going to come back to you with more. And so let me just go to Rishi, because Rishi, both of you have not spoken before, so the audience would like to listen to both of you first, and then, of course, go to our eminent speakers. IFRS, Rishi, the International Financial Reporting Standards, the global language of business, if you may allow me to say that, is mandatory in more than 100 countries, almost 140. US GAAP, to some extent, has been relegated to the second position. Used to be number one in the world. A lot of people ask me, what is the distinction between US GAAP? And it's pretty similar. So what I normally say is that the US GAAP is more rules-based, whereas IFRS is principles-based. Now, to give you an example, if you're driving on Sheikh Zayed Road, those of you who are from Dubai know that we have speed limits. And now there are very stringent rules. The fines can go up to 100,000 dirhams. So we have to be very careful of the speed limits and the traffic fines. So if there is a sign which says that the limit is 100, now if you're under US GAAP, what would you do? And what would you do under IFRS? Okay, if you are a rule-based system, you would follow that rule and say 100. Before I go there, I will kindly maybe speed, but I'll be, when I go into that particular buffer where it's the restricted or camera, I will go to 100. Now, IFRS says they don't give a rule. They're not prescriptive. They will give you an interpretational kind of a standard which says that it is risky to drive at a high speed, and you be careful, we'll give you the guidance. So therefore, IFRS became more popular because what was happening, the very good example is the lease accounting. When you wanted to capitalize a lease, the rules-based system said, if you are 90% of the useful life, capitalize. So people used to work around the lease to make it 89% or 85% and still not capitalize. Now, IFRS has kind of, gone over that and made it very difficult for people to go and beat the rule. Keeping that in mind, if UAE is asking you to prepare under IFRS, do you think that is a big challenge? Because all the interpretations which will be there, could your interpretation of what is significant, because that's how IFRS uses, major, all these things will be very huge. So do you see that as a challenge?
Yeah, very good question, Abbas. First of all, I would like to emphasize that with the adoption of IFRS, so other accounting standards would not be accepted by the FTA for the tax filing. So that's a big change. And coming to IFRS, there are a lot of things which needs to be followed. So for example, the IS 24 on the related party transactions. So so the interpretation of related parties as defined in IS 24, it says that which has a significant control or influence. And the definition of the close relatives in the IS 24 is limited to your keens. But whereas if we look at the definition of connected persons in the corporate tax, that's a wider angle. So that's one where the principal basis will apply. We have to look at those definitions. And when we talk about other accounting standards like Indian accounting standards or the US GAAPs, those are pretty rule-based standards. And when the entities here in UAE will move to IFRS, they will have a lot of challenges in terms of interpretation. For example, the useful life of assets or the leases, those are all based on the usage or based on the management estimates. So all those assumptions and judgments will kick in. Apart from that, there are a lot of other judgments like the provision for expected credit losses, your impairment provisions, judgments account, and the classification of investments. So a lot of things has to be seen when to adopt IFRS. So that's a bigger change which will happen in 2023 when people move from other accounting standards to IFRS. And apart from that, people have to look around the disclosures in IS 24, which are different from other accounting standards. For example, your lease accounting disclosures. If you are moving from an Indian GAAP to IFRS, the disclosures are pretty different. Or you are moving from US GAAP to IFRS, so some disclosures are different. For example, the actuarial valuations. So all those things have to be looked into. Does that answer my question?
Thank you. Thank you. I'm going to come back to you with some very burning issues under IFRS. Okay, we've just heard a fantastic presentation by Basil, and he talked a lot about temporary differences, permanent differences. I'd like to start with a quote. And Scott Peck said, we should share our similarity, but we should celebrate our differences. So while we have differences, but we need to celebrate them. Coming from that perspective, Basil, I'd like to ask you that there are a lot of differences between the way that the tax looks at things and the way that we do in accounting. One such thing that strikes me, which I've worked under the US system, when you do on the IRS, is the depreciation. Depreciation under US GAAP could be under LIFO, dollar value LIFO, could be, straight line, whatever, under IS2 similarly. But under the tax system, especially in the US, because it's very advanced now, they are now talking about, first they started with something called acres, and now they've called modified acres. So now, do you expect something of that sort to come in with the FTA, getting active and try? Because as you rightly said yesterday when we were speaking, what we have right now is a very basic 101 of the tax system. So
correct. And then, yeah, so that's an interesting one because I've also worked a lot in US tax, and in addition to acres and makers, there's accelerated bonus depreciation concept. But all of these are to give incentive to the companies to continue investment economic perspective. As you think of UAE corporate tax, and then when you speak with the FTA, they'll tell you their first area of concern and priority is ensuring a proper and smooth transition and introduction of UAE corporate tax. So really what we have today is the most simplistic set of rules with respect to UAE corporate tax. Still a lot of challenges around them, but very simplistic. When we looked at the list earlier today in terms of what are the book-to-tax adjustments, very minimal in terms of adjustments. Adjustments more around non-deductible expenditures that are very common from an international norms perspective, whether it's fines, penalties, meals and entertainment. So those are very basic concepts. Other than that, we had exemptions around permanent establishments and dividends to avoid double taxation, but nothing around provisions, nothing around depreciation. The expectation is those rules will come into play, but they'll come into play later on. And the concern around them, and I think where a lot of comments are being provided to the FTAs by the advisors, is if you're going to start changing tax depreciation from book depreciation, you need to be very clear from the onset in terms of what happens for new assets versus what happens for the old assets. What kind of grandfathering rules are you going to start implementing? How do we keep track? Don't forget, whatever rules the FTA is going to put in place, they need to audit this. So there's also an area of challenge for them where if the rules are overly complex, then auditing them will not be an easy thing for them to do as well. So they see the issues on both sides of the equation.
Thank you, Basil. Thank you. Okay, now we had another very good presentation, and Mr. Thavan is right next to me. The essence of sustainability, according to me, and I quote, Gaylord Nelson said, "The ultimate test of man's conscience maybe his willingness to sacrifice something today for the future generations whose words of thanks will not be heard. So we have to sacrifice today for the future. This is, I think, the essence of sustainability. From that perspective, Mr. Dhawan, where do you see that the stakeholder support, as you've been talking about, stakeholder engagement, how do you think that is so critical? And could you tell us a little bit more about what it actually entails?
Absolutely. I think when we consider this topic, I like to simplify it as much as possible. And when we talk about stakeholders, I think let's limit this to investors and lenders. And to show how important this is, let me just share a couple of examples from the past year. There's an organization that went on a debt-raising roadshow. And this is a large organization. They were seeking values in the billions. And as an organization, it has a legacy. It has the reputation in the market. It has people that love working there. It almost has a tick in every single box. But the box that they didn't have a tick in is actually having a sustainability report that covers off all of these things that the lender was looking for. Now, some of the things that the lender was looking for were part of the standards, part of the guidance, part of the priorities, part of the goals that we looked at, that complex web of all the different pieces coming together. And some of the things the lender was looking for was not part of that. But an organization that would otherwise be considered a gold standard organization was not able to raise the debt due to sustainability disclosure gaps, let's say. I think that's the politest way of putting it. Now, this is a gold standard business. This is one of the safest organizations that you would want repaying your funds. So this wasn't a financial choice by the lenders. This was a values choice. And if you have organizations that are there to literally lend money to other businesses that are saying, you know what, I don't want to lend to you because I don't feel you've aligned as closely to my values as I would like, I think that sends a very powerful message. So in terms of the sacrifice today, when you have organizations like this making these choices, I think that tells you a lot about how serious people are about making those sacrifices and making those choices.
Thank you, Mr. Dhawan. Shahrukh, coming back to you. We know that the M&A right now is not the way that it used to be. Maybe it's some kind of a slowdown. So what is the market right now doing? What kind of assets are selling? What does good look like to you, and how do you prepare for it?
Well, let me start with where you ended up, which is to say that actually the ultimate test of ESG is in how investors look at it. And I'm already seeing that. In partial answer to Abbas's question on where the market is looking at, what I would start with to say is, look, and let's focus on our region. What's driving M&A in our region? What's driving M&A in our region is a sense by both countries that drive it, which is the UAE and Saudi, of local champions. It's all about, we want local champions on the international stage. And the second thing that drives it is the fact that there is plenty of money. So, I am seeing increasingly the government's aims at sustainability. One of the top sectors that's driving M&A is what happens in the transition of energy, right? Let me give you a couple of examples. I'm working on a massive deal where the powertrain businesses of both Renault and Geely are being combined This is a multi-billion dollar deal, and it's coming from the point of view that the individual entities cannot sustain that kind of investment, and that they need to combine lots of M&A in there to be able to deal with the future, which is going to be expensive but necessary. Other deals are about strange parts of ESG, natural ESG. I don't know whether you've talked about it. Algae blooms and such like has come up. There are something, I think that's one major area of investment right now. Tech continues to be so. Food security continues to be so. Finance is going back a little bit. Infrastructure in all these sectors is driving it. Right? And what does good look like? Well, look, I mean, M&A at its highest level is pretty much motherhood and apple pie. Have you got a good idea? Have you got a good differentiation in your market against that idea? Are you in the good markets in the sectors? And are you presenting that well? It's not difficult, but in the detail of how you go about it, it's incredibly important right now. Prices are good, but you have to show a good asset.
Thank you, Shahrukh. Rishi, coming to you, the way that we look at now with a lot of differences, I mean, as we heard about from IS 12 perspective, do you believe that at some point in time or currently, is there a requirement to have a separate set of books for tax versus financials because there are so many differences that may evolve? And that's one. Second, what do you think is the impact of the difference in the groupings under the FTA and the VAT law on the financials?
Yeah. First of all, on the two set of accounts, I would say that two set of accounts are not necessarily required. What is required is a reconciliation of the tax profit and the book profit. For example, the interest expenses disallowed in 1 year could be claimed in the next year. So that could be a difference between the tax profit and the book profit. Second example could be the transfer pricing adjustment or any other disallowed expenses. So there has to be there is no need to maintain two set of books of accounts, but there has to be a proper reconciliation. So and apart from that, on the second question, on the groupings. On the groupings, so there is a difference of groupings between the on the corporate tax side and the VAT side. For example, the mainland companies and the free zone companies can't be grouped under the corporate taxes. So in that case, there has to be separate set of accounts prepared for submission to corporate tax at the time of filing the tax return. So the consolidated accounts which has both the mainland and the free zone companies might not will not work for this purpose, and there has to be a separate set of accounts, either audited or unaudited, but separate reporting is required for the tax purpose.
Thank you, Rishi. Basil, my favorite thing is the differences that you talked about, permanent and temporary. Stephen Covey, the man who wrote the best-selling book, The 7 Habits, said that strength lies in differences, not in similarities. I don't know if you subscribe to that view, but from the tax perspective, there are a number of differences that you see already emerging. For instance, under the IFRS, IS2, the way that you value the inventory could be different. Under US, IRS tells you to do it under the UNICAP. Similarly, for the allowance for bad and doubtful debts under IFRS 9, there's a huge kind of way that you do a lot of disclosures. Now, talking about that, how would you then see that as a challenge for people who are preparing the tax returns? And would they have to engage some experts to deal with these situations of valuations and allowances for bad debts?
Yeah, that's a good question, because from a tax return perspective, right, let's not forget the starting point is book income under IFRS. So tax return preparers will start with that and just run whatever adjustments that are needed. There are not that many. So a tax return advisor would not necessarily dive in depth in terms of what are the accounting standards. But for somebody who is thinking about the impact of a UAE corporate tax with respect to their entities, suddenly accounting standards will take a much deeper meaning than they ever used to before. right? We never used to revisit accounting standards unless something was changing in the standard, so we had to relook at it. Otherwise, we adopt an accounting standard, we maintain it, and life goes on and on and on. We are seeing a lot of entities now revisiting their accounting standards. Something as simple as fixed assets, right? Fixed assets, do you use cost method or do you use the revaluation method? That has a dramatic impact. Why? Because right now, tax depreciation is equal to book depreciation. So if I can find a way to increase my book depreciation, then from a tax perspective, I'm in a better position. It's easy to sort of think about it that way and recommend such a change, but at the same time to use a revaluation method, well, requires valuations to be conducted. So practically speaking and commercially speaking might not be the best solution. So that will vary industry by industry. The real estate sector is very, very worried about gains that currently exist but haven't realized, so all of the unrealized gains or inherited gains on some of their assets, and how do I shelter these from taxation going forward? There was a cabinet decision that was issued that provides some form of relief, but not total relief. So there's a lot of questions around what are the planning ideas from that perspective, and accounting standards revisiting accounting standards is definitely one of them.
Thank you, Basil. Thank you so much. Mr. Dhawan, I'd like to ask you that in your fantastic presentation, you talked about the different standards like GRI, there's something from the United Nations, there's a lot of standards that are there around the world, and now the ISB has also set up their own, S1, S2. So where do you see that these standards are going? Where do we actually look for guidance? Is it because the ISB is still emerging, right? So do you look at GRI? Do you look at some other standards? Where should people who are initiating and starting to apply these standards look for? What guidance?
This is an excellent question, and I think also a very difficult one at times. My team tracks over 85 separate standards, regulations, and data sources when it comes to ESG, because we want to try and understand where the good thinking is coming from. And ultimately, if a client says, I want to have something tied to PACTA, to SASB, it needs to be GRI compliant, this. We need to be able to go and figure out what that actually means. But it's a very complicated landscape. And I would actually break it into two pieces. I think there are the requirements and the frameworks, and then there's the reporting component. In terms of the requirements and frameworks, I think there will continue to be lots of different data sources. We look at it simplistically as the Sustainable Development Goals being the heart of it, the GRI being the next layer around it, and then everything else in some way, shape, or form sticks to GRI somewhere. And that's how we think about it. But this is on the framework and standard side. On the reporting side, I think the recently released standards S1 and S2 are probably the best starting point to make sure that you're going to have consistent disclosures. Because from a strategy perspective, you need to look at this universe of standards and frameworks. But from a reporting perspective, well, there's only these two things, and these are IFRS, which, as we mentioned earlier, is effectively taking that pole position. So I personally think it's a brilliant starting point. But where do you go for guidance? On the reporting side, I think you have two very solid standards. I think there will be more to come out over time. And on the framework side, I think go back to those Sustainable Development Goals and the GRI standards. Those would be my recommendations as starting points for anyone that's looking to get closer to this.
Thank you, Mr. Dhawan. At this point, I'd like to also call you Kabir, if that's your first name. You're coming out very intelligent things. So you're actually acting like Kabir, the historic Kabir. Thank you for all your great input. I have Shahrukh, who is, again, very, I would say, full of energy. He has a lot of ideas. So Shahrukh, a lot of people are wondering that since you're the head of deals for KPMG, Saudi, and also do a lot of M&A, but what about restructuring? There are companies which right now have debt on their balance sheet, which they are probably not able to repay. They want to restructure. I mean, in America, we call it the trouble debt restructuring. So can you throw some light on that, please?
So look, almost certainly we're seeing that with interest rates rising in the way that they are. Companies are under stress. We also know that if companies get into real trouble, there isn't the Chapter 11 kind of protection. Well, there is, but it doesn't work quite as well in the region, right? So I see companies right now who are doing that, approaching us. We still haven't got to a round of refinancings because that's not the answer right now with rising interest rates, right? So, I mean, that would be a self-defeating proposition. If you've got a good deal, keep it on the debt side. What I see companies doing right now is the traditional turnaround. So it's about your operations. It's about your operating efficiencies. It's the simple things which release cash, working capital, supplier arrangements. So I am not seeing yet, and it will probably come, I'm not seeing yet the sort of major failures. What I am seeing is companies recognizing where they're coming under cash flow and basically threats to their ability to service the loan, looking internally to improvements. That's the trend that I'm currently seeing.
Thank you, Shahrukh. Thank you so much. I'm sure a lot of people would like to come to you to seek your professional advice.
I'm here on my... I'm in Saudi, and my colleagues Anshul, who you may know, Anshul Gupta, and Rajiv Malu are here as well. Please call any of us.
But they have to go through Mr. Harikrishan, through the chapter. Anyway. Okay. Rishi, we have seen that when the VAT was implemented, we already have VAT audits happening, right? Under the corporate tax, do you think that that might also be one of the things happening? And then people have to be ready. That means that the FTA is going to question you on many of your deductions. So do you think that is a challenge? That's one thing. And also, I think the retention periods, if you can talk about that, they're different. And lastly, I would also like to ask you, withholding tax is a major thing in many jurisdictions. Is that going to come in the UAE?
Yep. First of all, on the audits, I would start by saying that when the VAT was introduced in 2018, that time there was no audits happening. But later we have seen that the audits have been happening for the VAT. So similarly for withholding taxes, right now there are no requirements, but sooner or later this will come. FTA will ask for the audits, for the tax audits. It should come. And second, they may ask for certification of certain balances from auditors like inventory or receivables if the accounts are not audited, or for the tax provision. So those things are expected that sooner or later it will come, the tax audits will come. For the withholding taxes, as we have seen in other regions like Saudi, Oman, other regions, withholding taxes are there. And right now in the current law also, the withholding tax provisions are there at 0%, but it is not tweaked to a percentage, I would say. So sooner or later, the withholding tax provisions are also expected that it can come.
Okay, so we have to be very careful, or rather be ready for all these things to happen. I mean, they haven't happened yet, but it's a good thing that
and
you're pointing
another
out.
thing to add is on the VAT side and the corporate tax. When we look at the intergroupings, so sometimes there are intercompany agreements are not recorded because in the VAT their groupings are different, and in corporate tax the groupings would be different. So that could be another area tax authorities might look at, because transfer pricing is a key area which will become a key pain area, I would say, for the entities which are not following the transfer pricing provisions. And entities will start looking into the transfer pricing, your cutoff processes, your choice of accounting policies, because you have the policy choice for fair value and cost. So that could be another area. So choice of accounting policies and overall audit procedures are very important, because if the income is flowing from one period to another period, so basically it could be a tax evasion if you are recording one period income to the other period. So all those things will become a challenge eventually going forward.
Thank you.
Thanks.
Thank you, Rishi. Okay, now we have the last round of questions from my side, then we're going to open up the floor for questions from the audience. Mr. Basil, you have very eloquently talked about the differences. You also mentioned about the tax positions, which could be uncertain under the IFRIC 23. Do you see that as a challenge here in the UAE, where, tax is not evolved, it's still evolving. I mean, that's okay, maybe relevant in the US or UK, but how do you see that actually here happening? Like people are going to take positions. I know you gave us a few examples, but if you can elaborate, because I think that'll be very relevant for people here.
Surprising enough, I have my sense is that uncertain tax positions will actually be a critical area, especially in the first few years, given that there's lack of proper clarity and guidance on certain positions. So you're in a country where you don't have a history of audits. We don't know how the FTA is really going to be interpreting the tax legislation. Are they going to be more aggressive from an audit perspective? Are they going to be easygoing? It's unclear. We can look at VAT as an experience to see how things have happened. And my understanding from a VAT perspective is the initial audits were more procedural, making sure things were sort of properly done. The more recent audits are a lot more aggressive in nature and requesting documentation and taking, more aggressive stance from an FTA perspective with respect to VAT. Will that happen from a corporate tax? It's a little bit unclear where that's going to be headed. We know the FTA has said it many times that they've learned from the VAT experience. So does that mean they'll come in with rigorous audits from the beginning and not give us a few years to sort of adjust? That's the part that's going to be unclear. So I'm expecting uncertain tax positions to be an area that's going to be significantly challenged by auditors as part of financial statements, simply because of, unfortunately, the lack of clarity that's going to be available, that's currently available from the authorities around certain areas of taxation. So again, going back into qualifying free zone persons, this whole concept of qualifying activities, a public consultation document was recently issued with, outlining some of the definitions and what's going to be in scope. But absent that and absent clarity around that, then what are qualifying activities remains somewhat open to judgment and interpretation. So there could be areas of risk from that perspective.
Thank you, Basil. Thank you so much. I'd like to now ask Mr. Dhawan my final question, then open up the floor for questions. Mr. Dhawan, we see that there are a lot of complex standards that are there. But what do you think is the most complex part of the standards from implementation perspective? And how do you see a strategy should be developed from the beginning in order for you to, when it comes, you have to be prepared. So you need to throw some light on that.
Sure. I think there's probably two parts that I would highlight. First, the most complex piece that I have seen relating to a large chunk of the standards and the reporting requirements is the need to track, measure, and take action about greenhouse gas emissions. These are typically broken into what we call Scope 1, Scope 2, Scope 3 emissions, and typically Scope 1 and 2 emissions, without going into the details, are the things that organizations can typically identify and track themselves. The Scope 3 emissions are effectively the emissions relating to your supply chain. So if you consider every single piece of spend you have on a vendor, goods, or services, being able to estimate, calculate, and take action about their level of carbon emissions is challenging. And there are very, very large organizations that spend tens of millions of dollars a year trying to progress this agenda. And there are small organizations that are also spending material amounts trying to figure this out. But I think this is one of the most complex areas right now. And as I mentioned earlier, this is an area that I've been spending a lot of time in over the last year. But this is only one part of the bigger puzzle, and I think this comes back to Abbas's point about strategy. If an organization just takes their first step by defining an ESG strategy, they are already ahead of their competition. Because when I asked everyone in the room to raise your hands if you have an ESG strategy, I think I counted 5 hands, which means there is plenty of opportunity to get an edge on your competitors, your industry, and so on. And an ESG strategy does not need to be complicated. Even if you don't have a regulatory reporting requirement around it, there is nothing wrong with setting out the things that matter to you, because ultimately these things matter to your stakeholders, to your employees, your shareholders, your investors, your board, your customers. So I think it's really important to at least take that first step. Even if you build on it every 6, 12 months, taking that first step is the hardest. But better you do that now and start getting to grips with it than the regulation comes in which mandates you to do it. Because when that happens, I think similar to corporate tax, you will see a shortage of skills in the market. Because all the professionals that understand this are suddenly getting called to support organizations on this agenda. And I'm expecting something similar to happen on ESG. As reporting requirements and regulation gets more stringent, you will see a talent shortage. Even in terms of consultants, I can't hire people into my team fast enough to keep up with the ESG demand. That's how difficult it is. So I think this is a real risk, and that's why I'd urge everyone, if you have the ability, at least take the initial steps on setting out an ESG strategy now, rather than when you're required to, because it will be much harder then.
Thank you, thank you. I think the message that you want to get across to people is that, as the old adage goes, that every journey of 1,000 miles starts with a single step. And that single step, according to you, is probably getting ready. Even before you start doing the implementation, the strategy is very important. Thank you very much. Shahrukh, I'd like to, before I conclude, the last but not the least, is that since you are based out of Saudi, and you've seen how the taxation has evolved, maybe something you can tell from your perspective, because we are still very new in the UAE. So what are the implementation issues? What are the challenges?
So look, I see everything that you've talked about. Legislation, when it's first drafted, is never very clear. So it leaves an awful lot of area for interpretation. So people take positions. Initially, those positions go unnoticed. And then, suddenly you find that there are investigations. Investigations involve penalties. What I have seen, to be fair, in Saudi, and look, our job when we do diligences is to come up with these issues, right? So we see a lot of them. Where do people have issues? People have issues in the, you mentioned transfer pricing. Transfer pricing is a big, big issue. If there is anything cross-border, transfer pricing, and if withholding tax is introduced, withholding tax is a huge issue. People forget about it. They forget that it goes on it, to the extent that Saudi actually had to introduce an amnesty to be able to catch up. Also, I tend to find the determination process doesn't work very well initially. I don't know what the UAE determination process was, but in Saudi, initially it was impossible to get a binding resolution. So it was Bantam's dog's law. You kind of had to make a decision and hope you were making the right one without consultation. Very, very recently they have changed that, so you can get a binding determination. That will be incredibly important because it caused an awful lot of distress. So be careful. Make sure that you are in touch with the authorities. And let's hope that the authorities will be sensible and have amnesties Look out for those and keep yourself clean.
Great, thank you very much. Words of caution, very important. Let's now have the questions from the audience, and we have our very dynamic secretary, Mr. Jay Agarwal, to lead that.
Thank you, Abbas. I mean, this is not the last question from your side. We will mix it up. Something will come from the audience, and then we'll again get back to you. Sure. But one thing I love about the panel, the depth Ms. Saruk has when he says, be careful, I actually get scared. Be careful. And on the second side, on the other side, you have such a calm voice. It does not look ESG is complex. With your kind of a voice, ESG will always be simple. Thank you, Kabir, for that. Let's go with the first question, Nimish.
Yeah,
Nimish, sir.
good afternoon. My question is to Mr. Kabir. With respect to the reporting which is likely to be there in the sustainability and all, any companies have reported so far any report voluntarily? It need not be, I mean, compulsory or mandatorily, so that we can refer it as a example and use that thing. And also, I believe our Indian institute is also promoting these sustainability standards in a big way. So how far the parallel can be drawn of those standards which are published there and can be implemented here?
Okay, so I think in terms of firstly finding a good reference point, I think there are two places that are worth looking. The first is listed businesses in the UAE. If we're talking from a regional perspective, listed businesses in the UAE have to produce this sustainability reporting. So I think there are quite a number of these organizations, more being added every quarter with the IPOs. This is a very good starting point. The second place I would suggest you use as a reference point is the financial services industry, particularly the banks, because they have a very complex web of regulations that they need to look at, but they still do mostly a very good job of reporting and managing that in the right way. In terms of the S1, S2 part of your question, I'll defer that to maybe another panelist if they want to pick it up from the technical accounting side. But I think it's very early and we need to see how it plays out.
Thank you. In the middle, please go ahead with your question.
Yes. Hi, good morning. It's CA Hardik Gupta this side. So first of all, I would like to thank all the panelists and speakers for such an informative session so that we have something to go back and analyze. So my questions, I have two questions mainly. So I am dealing in gold and jewelry industry. So these two questions are the burning issue of IFRS. So first relates to the valuation of inventory. So in that industry, there is one concept called unfixed purchase and unfixed sales. If I give more clarity on that, so that unfixed purchase means the price is not fixed, so we can't book the purchase at that time. So say in IFRS, so on 31st December, I buy 100 kg of gold. So 50 kg is fixed and 50 kg is unfixed. So at the end of the financial year, I have 100 kg of inventory in my books. So 50 kg I can value easily because it's a fixed transaction. But another 50 kg, what we can do for that? Is any IFRS give any guidance on that? How we can value that 50 kg unfixed stock?
For this kind of situation, I can't say that there is a specific guidelines in IFRS, but what can be done is we can wait for the year after the year end to see when the price is subsequently fixed to see what is the definite price of the inventory.
But on the year end, how we will value the inventory, like, because the financials will be
on the relative, or what is the price of gold at the year end market price. So IFRS 13 we can refer to look at the market price and do the valuation of the inventory. So what is the fair market price of the inventory? So that can be seen.
Right now the industry is doing that only, but if we go through the IFRS says we have to value the inventory at cost or NRV, whichever is lower. as the cost is not determined at that time. So that is the issue becomes in this industry right now.
So what is the other 50 kg, the price which you have used for that, the same price can be used for where the price is not committed, because that is the most relative transaction you can see to value the price, because you have to book the liability for the inventory which is booked in the books.
Thank you, Hardik.
And the second,
yeah,
and the second issue is like similarly on the sales side, if I am selling on the unfixed, I am making an unfixed sales, then again I have to take that fair value or the provisional value, because the revenue becomes a most important thing now, because there are so many things or limits in the corporate tax which are based on the revenue. So if I can't determine the correct figure of the revenue, it becomes it may become a problem to me.
You see, if the transaction price is not fixed, then probably it is not deemed as a sale under IFRS 15, because there's a 5-step model under IFRS 15 which we have to follow to recognize the revenue. And one of the components is the transaction price. So if that is not completed, then obviously your performance obligations are not there.
But in transaction value, I think there is a concept for this variable consideration also. So can we use that concept? And because the goods will be transferred, the control is already transferred. So I don't think we can't say like I will not be able to book the revenue because the control is already transferred.
No, but if the goods are transferred, there would be some consideration you must have agreed after the year, and probably in January, first week or second week, you would have agreed some amount. So that can be used as the transaction value, not necessarily on 31st December, but probably in after the year end, there would be a transaction price to both purchase and sales. So we can look at that and fix the transaction value.
Okay, what I suggest, Hardik, since Rishi is also our member, we can take it offline. Both of you are member of our chapter. We'll take it over coffee. Abbas, back to you. You have any questions? Then we'll come back to this. If you have any questions for the panel.
We have very good discussions that's going on from the audience, and I've already asked some of the questions. I'd like to open up to the audience and then maybe concluding remarks.
Perfect.
Yes.
Then we have here a question to go. Okay, please go ahead, Rajesh ji.
Thank you for informative presentation, Mr. Kabir. My question is that the biggest challenge in implementing the sustainability is survival in the present. Although in principle, most of us are in agreement that we should implement it, but the moment we start implementing it with 100% acceptability, for example, the zero emission, zero carbon emission, most of the industry will become unviable. Do you feel that is there any ecosystem can be developed at the government level or at the central level which can support this transition by way of, for example, providing tax revenue, certain percentage of tax revenue for sustainability support, or some initiative which can directly support to the business which are generating more environment damages and provide them the, without that, according to me, it will keep hanging in the air and people will find the difficult to implement even though principally ready to accept it.
I think that's a great question. In terms of breaking this down, the goal isn't to have 100% achievement on every target from the standards. Today, if you're demonstrating progress against where you were 12 months ago or 24 months ago, that is a great place to be. And I don't think you will ever get to a situation where there are requirements to say you must not use any water you have not produced yourself as an organization. They're not going to get this level of focus. I think it's awareness, progress, and start to see the results. But in terms of whether we'll see any support mechanism or structure, in some regions, the government will underwrite lending. They will provide certain types of product requirements to banks to say that if, for example, you are lending to an organization that meets all these criteria, we will pay 1 percentage point of the debt, you discount it slightly. So there are some structures that can be put in place, but I don't think you need government intervention, because there are organizations that do this voluntarily. There are hedge funds, there are private equity funds, there are parts of sovereign wealth funds that have green portfolios. They have green investment criteria. They actually look at this as an asset class, because they look and they understand that across these sustainable development goals, this is what the world is going to focus on for the next 5, 10, 20, 50 years. And therefore there will be growth in this as a proposition or as an asset class. So if you have an organization that says, you know what, we're going to make it our vision to produce clean water from dirty water, but at a cost level that we can deploy it in Africa, they will look at that and see an attractive investment, not a difficult situation. So I think there's a lot of nuances in this space, but I don't think government intervention is required, and I don't believe that you're going to have very stringent targets placed. I think it will continue to be about incremental progress.
Great. Yes.
My name is C.A. Shivanshu. My question is
Can
to
you
Mr.
hold the mic close?
My name is C.A. Shivanshu, and my question is to Mr. Kabir. As far as ESG reporting is concerned, there have been some developments in integrated reporting. For example, in South Africa, they made it mandatory to have integrated reporting. So in IR, they are basically human capital and number of capital reporting. So is that how ESG reporting is going to progress, or that's the thing?
I think if we're estimating how reporting will progress, I think what you will see here is an expansion. Today, a listed business has to pick a number of categories from within the GRI standards and then talk about a number of subcategories. And that is not mandated. There is no requirement that you must pick X number of points from that list. I think over time, you will see that become more and more stringent. So you will be required to report across all of the primary categories, and maybe also at least highlight compliance or non-compliance with all of the subcategories. I think this is my personal view of how this might play out. Depending on other standards, other regulation, you might have indicator-based reporting. I think it's somewhat fluid at the moment, but I think most of the professionals in the space look at GRI as the most comprehensive baseline, and I think it will be very surprising if something else comes in to dislodge that in the near future. So I think as long as you're focusing on that, you will be kept up to speed with what good looks like.
Thank you, Kabir. I mean, a lot of questions are coming to you. That means we are very serious about ESG. This group is very serious about ESG. Rishi, go ahead with your question, please.
Yeah, thank you. So I have a question with Shahrukh. I mean, this is a pressing question. I don't want to go with upset stomach if I don't ask this question from you. One is, there are two questions basically. One is DIFC has recently, I mean, some months or a year back, talks about IPOs for the SME space. But I mean, personally, I tried learning a little bit about it, try to help people, but it's not very clear. One question is that. So your thoughts on that. Secondly, my question is about the capital raising. With the interest rates rising, there is always need for capital for businesses to grow. So what is your recommendation from your experience, why it is difficult for small or medium companies to raise capital compared to large companies? What they can do or plan that can help them raise capital easily?
Let's start with your DIFC question. So yeah, look, the DIFC have made an announcement. It always takes a little bit of time for that kind of thing to gather momentum. I mean, if I look at Saudi and Nomu has been there forever. It's only in the last 2 years as investors have really begun to understand and begun to have faith in the SME sector in Saudi because of the wider economy's multiplier that no-move financing has become popular. So I think, and that actually links to your second question as well. Large companies find it easier to raise it because they're large and they're established. The issue with financing SMEs quite often is the ability to see the sustainability of the business model and the sustainability of the business model in the wider economy and confidence. It is when that arrives, and it depends very much upon the wider economy, that that kind of financing will become easier. At this point in time, I think it is difficult for SMEs. But I will tell you, there is plenty of money around for a well-formed idea. The trouble is there are too many ideas amongst the SME population at this point in time which are just ideas, right? And just ideas are very difficult to finance under today's economic conditions. So where there is an idea backed by a demonstrable cash flow, you will find money and you will find a good price for that money. It's that is required. There is no easy answer to it, I'm afraid.
Perfect. Not an easy answer. This is the last question for the panel. Please go ahead, sir.
My question is to Basil. Corporate tax regime is already in place in other GCC countries, be it Qatar, Saudi, Kuwait or Oman. So do you see the journey of UAE corporate tax regime to evolve in a similar fashion as these countries, or do you see any major differences already being in place?
No, that's a great question, and I think the answer is it's absolutely going to be going in the same direction. And you look at KSA, what they've done. The UAE is keeping a very close eye on what KSA is doing. You see a little bit around free zones and exemptions from a free zone perspective, regional headquarter being announced in KSA, then headquarter services being exempted as a qualifying activity from a UAE as a counter to that. So I think there's a lot to look at from a similarities perspective, but I do think as well that UAE will try to adopt norms that are a little bit more international to try to differentiate themselves a little bit.
Yeah, sure. Okay. Look, I do see that in Saudi already as well, because I mean, if you look at the differences, right? The UAE is taking, as I believe, a very income tax based approach, whereas Saudi has a very zakat for locals and an income tax for foreign ownership. So I think I agree with you that the UAE is taking very much more of an international approach to it, and Saudi is taking a little more of a localization approach to it. And I think that will drive the differences.
Great. Thank you. Thank you very much. I'd like to personally thank all the panelists, very eminent speakers, all of them. And I'm sure that our chairman is happy that we worked so hard from the last 2 days and we were able to put together something worthwhile. Are you happy? Thank you. Thank you, sir.
Thank you. A big round of applause for the panel. Yes, they were working hard for the last 2 days to ensure you get value added in your life. Thank you to all the panelists and moderator for enlightening us on such an important and diversified subject, starting from IFRS, mergers, acquisitions, tax groups, ESG, and IAS 12. Everything was covered. Thank you very much. Now what I will do is I will invite chairman, vice chairman, and our treasurer to appreciate and share our love with the panelists who are left. We'll start first with the panelist here, Rishi Agarwal. Please come in the front. Farooq to come, and thank you for gracing sir. Lastly, the dynamic, ever dynamic Abbas sir. As a moderator, you always do a fantastic job. Please come up for our share of love. Our big round of applause. He was traveling, but he ensured that he does justice to the session. And a group picture with all the panelists and the moderator. Thank you, everyone. Thank you to all of you for joining on a Saturday morning. And it was very good numbers when you joined in. We had our fears that whether you will be coming or not, but we are happy that you made it. Thank you very much for joining us. Give a round of applause to yourself. I will fail in my duties if I do not acknowledge our sponsors. They are important part of us as a chapter. Our title sponsor, Bricks and Woods Real Estate, principal sponsor, Stocks and Ground, MBG, Mayur Batra Group, Tally, IFCO, Lulu, AGMC as principal sponsors, platinum sponsors, NEF Chartered Accountants, UHY James, SBC Consulting, WMS CloudSook, NalSoft, ECAG, JEDOX, FMCG Aktia, magazine partner, Finance Magazine, Media, KT, and institution partner, Delhi Private School. Thank you to all the sponsors. Give a round of applause because some part of the contribution comes from our sponsors. Thank you very much. Thanks a lot. Have a nice weekend ahead. Ho gaya, sir. Thank you.